Good morning, everyone. So, as I said, it is a daunting task. How do you value a company which has never been valued? So, it is a challenging task. It's like gazing a crystal ball and trying to figure out what the future holds for the company. So, it is with great excitement we are pleased to welcome Mr. Ramkumar Chidambaram to this special session on startup valuation. He has an extensive career in startup valuation, M&A acquisitions, and fundraising. He has a pivotal role in these fundraising up to around $3 billion, and he has been a trusted advisor to the CXOs. He has been instrumental in M&As, fundraising, and startup valuation. He holds an MBA from the SPGen College, this Management and Research, and he is a rank holder in Diploma in Finance and Banking. So please join me in welcoming Ramkumar Chidambaram.
So hello, thanks a lot for joining this session. I know it's raining, but anyway, let's start the session. So I think very kind of the lady to give me an introduction. So let me give a brief overview about myself and also in terms of what you are looking to cover in this session. So I've been in this M&A and investment banking right after my college, so somewhere from 2009, and I've been in this field for more than a decade now, a decade and a half. And obviously, when I joined, it was a Great Depression, 2009 financial crisis, and at that time, the Facebooks or Googles that we were seeing now, being the big tech, they were just starting to come up. And over this from 2009 to 2020 till COVID, there was a huge upsurge in terms of how the tech companies have come, and also there has been a huge surge of startups. When you see Google or Facebook, they have been startups at one point of time being funded by Sequoia, and they have become unicorns, and they have become, some of them have reached a market cap of 1 trillion. And it is these startups and the VCs who have been responsible for the big part of the economy and the GDP growth in the last decade. And so what was seen as a hub in Silicon Valley, where you have startups and venture capitals working together, having a great synergies, have reached out to India also, especially after this government has come, where they have done a lot of investment schemes, lot of incentives, making the entire climate very favorable for startups. So that's why we see a Flipkart starting the boom for Indian startups. And in the last year, I believe that more than 30 to 40 companies had reached the unicorn status. And then there has been a very bad time for the startups, partly because of the governance issues, partly because there hasn't been a good product market fit, and partly because many of them have been valued at a very high level, which they have not been able to achieve or meet the expectations. So in this session, what I'm going to do is try to take this entire startup fundraising and valuations from the perspective of founders, someone who's looking to start an entrepreneurship, and someone who feels that he needs funding to scale up his business. And what should he do if he has to sell his part of the company to a venture capitalist? What are the things that he has to take care of, right from the valuation to and there are certain peculiar things that we need to look at when VCs fund startups, which are quite different from how the public companies are valued. So public companies, you have a valuation template, you can do it through pricing or cash flow approach. Because in startups, a lot of companies are in the initial stage, don't have an history. It becomes very difficult to value such companies. And when you look at an investor, he's not only looking to go for an upside, but he's also looking to protect his wealth. So what are the key provisions that he's going to put it in the term sheet to bind the startup and ensure that he doesn't go for a big loss? And then finally, we also look at what are the red flags that you need to look at on the fundraising side. So basically, I would want to take this presentation as very conversational. So I have some experience. I will share some stories, I'm sure that all of you will have a lot of diverse experiences, and I would be eager to learn a lot from you in terms of how you approach, if you have some experience, not only on the startup side, but also on the equity research, valuation side, because I'm sure that there are a lot of startups that have become publicly listed, like a Paytm, or now Jio has come up. So many of these are still burning cash. And how are you doing an equity research for such companies? It will give me a good amount of feedback, and also be able to revise my sort of an approach in terms of how I value companies. So going with that, I'm starting with the presentation. So any specific areas that you want me to cover apart from what is there in the agenda, you can tell me now itself.
So it's interesting you said Jio in the group of companies like Paytm. I know you mentioned Jio in equity valuation perspective, like for a company like Jio, it's completely different how you look at financials or metrics, right? Compared to company not even like Paytm. So see,
what we do is that we see Jio Financials as a fintech company, similar to what Paytm is. So when you value companies, you basically assume that there are certain areas in the conventional banking side which a fintech company is going to disrupt. So when I say disrupt, what it means is that there are certain areas in the banking where you can scale at a lower cost, which technology allows you to do that. And now with Jio coming in, the differentiation is not only the technology but also the data. For instance, you know Reliance Retail, right? And there are huge treasure of data on the merchant side that Jio can exploit. Anyway, the technology is not going to be differentiated between Paytm and Jio, but what is going to be a differentiator is going to be the information that Reliance has access to, which Paytm may or may not have. Second is it has also got a license with which Paytm has struggled to. So yeah, so that is on the Jio side. But what happens is that you see a Paytm, it was a startup 10 years back, and it has come up being a unicorn and become listed right now, still burning cash. So so what I was trying to tell is that how has it been valued, like over a period of time. So when you say a startup, you fund a company from the start. You say you take money from your seed financing or from your family and friends, and then over a period of time, when you achieve the milestones, the funding starts to come, and every round of funding will have a valuation, a term sheet. So how has the investors valued that company at each stage, and have they valued it correctly? There could be a case study, because if you look at Paytm, at IPO, it was a miserable failure, right? It was I think the expectation was around 2,100 rupees, and it has still not reached that price. And then it moved to a low of 450, and it's still now somewhere around 850 to 900 rupees. The expectation is still not there, and I think that's also one of the points that we need to look at, is that the expectation of the investor. So what a VC expects from a startup or a founder may be completely different from what a public market will expect. So that's the reason why they might have reached the unicorn stage, or they might even got a funding from Warren Buffett. But what a public market looks at a company is simply different. And also you have a lot of corporate governance practices coming up, which these startups have generally not been good at, and VCs also overlook it. So yeah, so that could be one of the areas that we could have a deep dive into. So as I told you, the key themes that we are going to look at the next couple of hours will be to look at the valuation. How do you value a company? It's a very simple approach, and you have multiple frameworks to do that. You can value it from a future perspective, and then discount it, which we say as a discounted cash flow. Then you also look at companies similar to that and see where they are trading at, and then do a multiple of it, which is called as a pricing perspective. And there is also something called as what happens if we liquidate it. So I have an asset, and I don't see a lot of revenues being monetized from that asset. If someone would have remembered when Google acquired Motorola's IP, So at that time, it paid a lot of money. So the big part of the value had actually come from the IPs of Motorola, which Motorola was not able to monetize it at all. But Google was able to do it from its Android Evolution. So you also look at the IP perspective and the assets perspective. In conventional, it would be somewhere like a PP&E. Like I have a plant, I have a equipment, I have a machinery, and even if I am not able to get cash from that, then what happens if I sell it? In that case, what will be the liquidation value? That is one sort of a valuation that people do it, especially when companies enter into bankruptcy. So where they incur a lot of debt, and what the lenders would do is that break the company into multiple assets and try to sell it to each of the buyers. That's also one of the approach, though they may not be the most preferred approach, because the assumption is the company is a going concern, meaning that the company will continue to be there for perpetuity. So we'll also see that. And second, we also look at valuation specifically for startups and early stage companies, and what are the key areas that founders need to focus on to avoid either undervaluing their company or even overselling their company. Right? If you look at Dunzo, the situation they have found themselves in, it's purely because they have I don't want to deviate too much, but generally when this startup era started to come in India, the focus was that India is a big market, so the TAM became such a big TAM, and they said that everybody is going to be in our market. And now fast forward a couple of years, that's not the situation. You see a Dunzo, you even see a Zomato. They don't operate in tier 2, tier 3 cities. Leave the villages also. Even tier 2, tier 3, you don't have Zomatos. And Zomatos have also understood it. They have restricted themselves, their food delivery industry, to practically 12 or 13 cities, because they don't want to unnecessarily invest in an infrastructure which is not going to yield a return. So what exactly is TAM? And if you are going to base your valuation on that, you end up overvaluing. And that's a learning from the VC's perspective also, because the VCs have entered into the Indian startups just a couple of years. Even their understanding with respect to a country like India and China is that it's a big market, and it's a big market, it is easy for me to sell. And but India is a complex market, and it is India. If you look at India, it's a confluence of multiple countries. So you have each region behaving differently. So what sells in south need not sell in east or need not sell in north. So it's very important that what your target market is, which Dunzo was not able to do, and it's actually I think there are talks that it's going to get sold to Reliance. So we don't know. So that we look at, and then obviously I told you the various valuation methods, and what happens when there is a agreement between a VC and a founder. He understands, he agrees to the value prop and says that okay, I'm ready to fund this much money in exchange for an equity. Then comes a term sheet. So what is the term sheet? What are the important provisions that are there in the term sheet? And what happens after the term sheet gets signed? So due diligence happens, and then it culminates with a shareholder agreement, after which the funds get exchanged. So we'll also delve deep into that, and also differentiate the three types of investments that venture capital does. So when we look at public companies, we always say equity, because as a shareholder, I get a common equity in a company when I buy a share. But for startup, it need not be a common equity. So VCs, especially at early stage, start with the preferred equity. Some of them, these are hybrid instruments. Like you have a debt, which means that you don't have any interest on the upside of the company. You lend some money, you earn an interest out of it, and you ensure that you get your principal back. So whatever interest rate that you put in is basically the default risk, meaning that what is the probability that a borrower will not pay. If the probability is high, then you increase the interest rate. Probability is low, then it is going to be a lower interest rate. Hybrids work in a different way. It has some certain characteristics of equity, certain characteristics of debt, and two very commonly used financial instruments by VCs are preferred equity and convertible debt. So preferred equity comes in variety of stages, like you have a convertible preferred, you have participating preferred, then preferred with dividends. Same with convertible debt also, which is quite simple when you compare to preferred. where you loan and then, but you also have an option to convert that debt into equity. I'll just provide a basic overview of that. I'll try to take certain examples of companies who essentially do a multiple rounds of financing, so that it just gives you a flavor. For people who have not done it, for people who have done it, obviously they know it. So the first part, we look at the fund. What's the corporate life cycle? How does it look like? And any company that starts, it has to go through a corporate life cycle. And I'm sure that people would know what the corporate life cycle would be. And then for a startup, in that corporate life cycle, what are the certain fundraising stages that it needs to focus on? Then also we look at what is value creation for someone who's putting his money into a startup, or be it even putting my company in equity. What is value creation for me? Purely it's the difference between what I buy and what I sell. So, and then there is some, in this we will figure something called as cost of capital. I'm sure you will be knowing that, but what's the cost of capital for a startup? What's the cost of capital for a public company? Public company, because it is trading in the exchange, you know the standard deviation, you can calculate the beta from that. And then obviously many of them would be fans of Aswath Damodaran. So you will know that he has a ready-made framework of how to calculate the cost of capital. So you look into that and also see that for a VC, what are the additional characteristics that we need to include in the cost of capital. Then the second one would be to determine the fair value. So here, as I told you, that you can value a company looking at its competitors, looking at cash flows, and looking at liquidation. Now, for an early stage company, let's assume a company starting to provide 100% AI sort of a business. Technology is new. Nobody has seen a AI company till now. Very difficult to find a peer or a competitor for companies like that. But in spite of that, you have to value, if you have to invest in that company. So what are the certain points that you need to focus on when you do that? For a fintech company or food delivery company, given if someone starts it, I know if Zepto is there, then I'm always going to see that, okay, what is Zomato doing, what is Swiggy doing? And there's going to be a benchmark for me, not in the food delivery space, but on the quick commerce space. So what's Blinkit doing, and what is Instamart doing? So that is, and based upon that, the valuation of Zepto is going to, somewhere the investors will look at, like, how is the food the quick commerce market approaching. The third is the net asset or replacement cost. It's the least used method, but there are certain times where you have companies have used this method. Then you look at fundraising, as I told, equity, debt, hybrid. Then we'll culminate with a term sheet and shareholder agreement. So when you look at corporate life cycle, we tell it as a S curve. So what do you mean by S curve? Is that any company that starts, be it a Tata or be it Godrej, it would have been started with someone's idea. Like someone would have thought that this is something that I would want to solve, any sort of a business problem or anything he feels that the status quo is not working very well. So something like edutech. Why there has been a disruption in edutech? Because people are hugely dissatisfied with how schools are run. People are highly dissatisfied with how colleges are run. You don't get good professors, you don't get the curriculum is not pretty good, and also is that the education is becoming very much a rich man's sort of thing, where if you have money you can get good education. You don't have a government that takes everyone into account. So what edutech, when edutech came into the picture, the approach was, let us make education affordable to everyone. Whether it has been able to achieve that or not is different thing. But the disruption was done purely because a poor person can have access to quality education through technology, which a rich person will also be able to get that. So there's an idea you start with, and whenever you start an idea, obviously you need cash, and the idea has to be validated with a product market fit, meaning that there is a certain amount of demand for whatever you are looking to provide. And there is a huge market that will be looking to buy your product or a service. And then obviously you need cash, and what happens is that you are not going to immediately earn profits. because a lot of your money is being spent on growth. So if you look at a valuation perspective, it's nothing but what are the existing assets, how much cash is generating, what's the cash that is generated from the new asset. If you, from a startup perspective, because they don't have an history, you don't have any existing assets that you can get cash from. That is highly the reason why they don't get debt from banks, because banks generally give you debt based on collateral that you provide, and in some cases even it's not collateral, at least they look at your receivables and other things. So for startups this is not the case. So how do you get access to cash, and what happens over a period of time if the startup survives? That's a big if. If the startup survives over a period of time, then what is going to be the cycle till it becomes mature and then it till exits? So it's going to follow basically an S-curve sort of an approach where the growth is going to be very huge once he achieves profitability, and once the markets that it plays in become saturated, then you have a lot of competition entering into, entry barriers are no longer there, and unless and until you are a Coke where your brand helps you to preserve your business, ideally most of them will start to dip, and then either they sell or they are going to have a renewal phase. So imagine something like a Microsoft, whose business essentially comes from the license sale of operating system and office packages. Now when the new CEO came, they pivoted their shift from their existing market to cloud, and that has essentially renewed the next phase of growth for Microsoft. And now it's the only company, a big company apart from Apple, that is seen as a huge contender in AI. So basically you see a lot of startups coming into this, but you have Microsoft as an exception. Ideally companies like Microsoft are very rare. Most of the companies, once they operate in a saturated market, they ideally divest, or they ideally are bought by private equity firms, and then they try to sell it and get whatever profits that is possible. So this is the growth stage. Now you look at how profit and cash evolves in this S curve. So the profit also follows the same curve as what the growth it replicates the same, and then but if you look at cash, it slightly diverges. That is purely because accounting profit and cash flows are different, and you need to reinvest a substantial amount of cash to generate growth. That is what we'll look at. So coming from a founder's perspective, what are the typical obstacles an entrepreneur has? And these obstacles are, I'm going to take this global. It's not something specific to India. It is happening in every part of the region. If you look at Alfred Marshall's economic books, he would have told at that stage itself that one of the entrepreneurship is one of the 4 important resources integral to the production of the economy. So what are the other 3? Is land or is natural resources. So land, if you can take it as a real estate. Natural resources could be oil. Then second is labor. What's the quality of your workforce? And the third is capital, banks. So if you look at developed countries, especially US and UK, their banking system is extremely strong, and because of that your GM, Ford and other road building railroad companies have mushroomed purely because of their enormous strength of the financial systems. So banks play an important role, and banks give capital. So these are the 4 important resources. Now what an entrepreneur does, and don't look at, when I say entrepreneur, don't look at only at the startup guys. Look at someone like a Tata, look at someone like a Ford. When he built an idea of making automobiles, what he essentially envisaged. So he tried to combine these 3 resources. He tried to combine whatever natural resources you have, which is steel for automobile, and then access to labor. So industrial revolution was a big for England. Industrial revolution was a turning point because of the labor force. And the third is capital. You had banks ready to give loans. A good entrepreneur combines these 3, and to generate value out of it. So first he builds an idea, then he takes idea as a business plan to the lender or an investor. Through that money, he acquires resources and then hire labor and then provide leadership to the company. So when the company becomes big, he hires second rung of leaders, basically to build the management muscle in the business. So if you look at all the obstacles that any entrepreneur faces, first is incorporating a company itself. Now we have come out of license Raj, but someone like an Infosys, they would know that how difficult it was to start a company pre 1991, and how difficult it was to get import, and because it used to have a tariff on everything that has to be either exported or imported. It's even difficult to get a forex financing also. So incorporating company, overcoming bureaucracy, purely because you need certain involvement from the government, and overall in large parts of the world, the governments generally function the same. The second is financing, get money. Third is hiring talent, retaining them. Fourth is acquiring customers. Fifth is providing leadership. And then sixth is how are you going to manage your competition. And when I say competition, you have to look at it from the market perspective also. Because today, your competition could be X company. But as your market evolves, your competition could change. So for someone like a Paytm, till before it could be a Bajaj Finance, but now it could be Jio, purely because the market is evolving. Even for someone like a IT service company, you usually say a TCS competes with Infosys. That need not be the case going forward, purely because when AI comes into the picture and you have a lot of new startups getting into this market, and when an incumbent gets into the market, the competition changes. But the most biggest obstacle for an entrepreneur is financing, purely because cash is the blood for any business, so or oxygen. So if you don't have cash, you are going to die. So for him, only if he has financing or if he has cash, would he be able to address the other obstacles. That is, you have to pay talent. So look at Dunzo. I'm just taking the example of Dunzo, purely because it has not been able to pay the salaries for its employees for a long period, purely because he doesn't have funds, and its fundraising sort of a process has been getting delayed, and that's the reason. And a lot of talent generally moves out if you don't pay. The third, and that will have an impact on your customer, because if your employees don't provide service, then your customers will leave. So the obstacles in financing will have a ripple effect on the other obstacles also. So if you look at the S curve that we had looked at in the earlier slide, only when the financing is there can this S curve move forward. The moment the financing stops, then this S curve will stop. That means this S curve will not have its shape like this. The moment Dunzo stops getting financing, Dunzo is not going to be Dunzo. It's going to get out of the market. Then the S curve, before reaching the growth and the renewal phase, Dunzo will no longer be there. So that's the role of what a financing provides. Why do you need financing for a startup? Yeah.
That you are talking about, it's about some real company, or it's just from like location?
Can you be a little bit loud?
This S curve that you have shown, it's from a real company. We can take a real example and we can say that, okay, here's the S curve that I have seen in Paytm or something, or it's just kind of a bookish thing. Okay.
So we can take the example of a Zoom or even a Google. Like all these companies, they are funded by Sequoia at the start. So when Zoom was funded initially, it was primarily looked at as a collaborative company, or a Slack was a gaming company, and then it figured it out that this market is not going to work. So it pivoted from a gaming company to a collaboration tool. So and then when its investors felt that it had a market, they started investing money, and then that Series A, Series B started. That is where this growth started to come. And once that growth became profitable, because the growth generally because in growth you burn cash because you want to acquire more market share. When it becomes profitable, Slack got listed. So that's where your mature stage comes in. It's a growth stage. Now what happens with Slack is that because Microsoft has its teams, it's not able to operate independently, and then it got acquired. So someone like you can take any company that has started, and to whatever phase it is in right now. It could be Amazon, could be Google. Either they have at this time, either they have been acquired, or they are in a public phase, and they have evolved into multiple markets, and those markets are growing. So for Google, it's no longer the advertising, but the entire funding started because it built a search engine, and because of the search engine, people were able to get whatever they wanted to search very effectively. This helped the advertisers to come in, and it became a great business model. So this business model was the reason why Google became Google when it got listed. But right now, Google has moved to cloud, it has moved to AI. Even if you look at their management, they don't say that they are an advertising company, they are an AI company. If you take any company that are now, they would have followed the S curve. So be it Google, be it Microsoft. In India, in US, in India, what has essentially been is that they are family-run businesses. So if you look at a Tata Group or a Birla Group, what used to happen is that, or even a TVS Group, what used to happen is that they start a company, they take loan and they take their own capital, they build it. Now they also start a conglomerate, then we start a related business, and because in the India the financing is not great, the banking system was not as good as in US. What used to happen is that whatever the core business in earnings, they used to reinvest in a new business. That is why you see a Tata Group starting with steel, moving to hotels, moving to other areas, purely because the core business, whatever cash, they were not able to get money for the new businesses, and they were reinvesting in the other part. So it is the S curve that you follow for any business, be it in India or be it in US.
Yeah, that's why I wanted to. My interest was to see the new tech companies of India, like Zomato and Policy Bazaar and Paytm. Where do they stand? Okay, what is the?
At this stage, they are in the growth stage. Still, they are in the growth stage, even though they have become publicly listed, for two reasons. One is that there is still a big part of India that doesn't still come under their TAM. So they are unbanked. Either they are unbanked or they are relying on the conventional banks. And there's a good way. That's the reason why Paytm's lending volume has increased so much, and they are looking at that being the big part of their business. Right before, payments was a big thing, but they see loans and lending being the big part, purely because big part of India doesn't have access to capital.
With the revenue and with the S curve, which shows the growth, whether the cash flow is coming or not.
I think you just use a mic.
Yeah, is it better?
Yeah, please.
Yeah. So my question was that whether with the S curve, which shows the growth, how does the cash flow look like? Is it flat or it's still?
No. Cash flow. Okay, we look at the next part of the slide. What will happen is that in the S curve, at the first part of the curve, you need a lot of money. And how do you raise money? Either you sell your equity or you take loans, right? But once you become profitable, once cash starts flowing in, equity concentration happens. That you see a lot of companies doing a buyback, meaning that you have excess cash, and not all the cash need to be reinvested for growth, because the return of capital is not very high. So what do? You generally take back the dilution part. And then, so when I say S curve, when it goes to the big part, the growth is maximum, the profitability is maximum, the cash flow position is maximum. Then what will happen? The markets, because what happens is that a company becomes bigger because the market is growing, and when your competitors also see that the market is growing, then your competitive advantage will come down, because a lot of competition is there. So markets will become saturated. So in that case, you don't need to reinvest a lot. You have lot of cash flows. So what are you going to do? Use those cash flows for? You give dividends to your shareholders. You do buybacks. Company that has diluted a lot of equity, they will do the buyback. Now you look at Paytm. Paytm has not still reached positive cash flow, right? So they need to do a lot. to actually get into that position. But the moment KTM has a lot of cash, the first thing that is going to do is going to do a buyback and ensure that whatever equity that is diluted is going to take it back. And then the moment whatever market is operating in, it is saturated, they has to look at the other market, which is the next growth market. What is the next growth market for the company? And if it is a related market, then you have a competitive advantage taking forward. If it is an unrelated market where you don't have any skill set, then it essentially becomes like a conglomerate. What you have Reliance, they are in petrochemicals, then they are moving to telecom. None of these industries are related to. So you either do that, or from a growing market, when it becomes saturated, you go into related growing market where you can transfer those sustainable competitive advantages to ensure that you keep on growing, because growth is not going to happen permanently. You have, in fact, if you look at many books, what analysts or economists say is that hardly a growth happens for not more than 5 years. The biggest part of your growth is going to happen, then the growth is going to converge to your economic growth. And then when that is going to happen, unless until you are a Microsoft where you are constantly innovating your business, you move to cloud, you move to gaming, you move to AI. So you are targeting new pockets of growth markets. If you don't do that, going to be in the same market, eventually your growth is going to converge to the economic growth or the GDP growth, whatever that could be. So that's it. Move forward. So why do you need cash? For a startup, you require cash to pay salaries, so which is your working capital. You pay suppliers. If you are taking some inputs from suppliers and then converting it into a value-added product. Someone like a software company or a biotech company, a big part of their cash is spent for R&D to come up with a new drug or even to come up with a new app. And the final one is marketing, where you need to, and you must be familiar with Byju's, where people constantly call you and say, boss, enroll me student and all those things. The big part of your marketing and advertising goes in acquiring new customers. Now, if you look at entrepreneurs, they actually underestimate the financing or fundraising effort. And first they underestimate, they think that it is easy to get or it is too complex to get. Second is that they go unprepared. So when they are going to an investor to raise capital, they are not well prepared, and there's a reason why most of the deals are not equal. You have a VC, a good VC, taking advantage of the immaturity of the founder and exploiting it. They don't know how much money to ask, how much equity to sell, and what is the value of the equity that they are selling. And the other problem is that they even don't know whether the problem is raising money, or the problem is that they don't have a good leadership or good product. So in many cases, the fundraising need not be an issue, but a product market fit could be an issue, purely because you think that this product will work with your customer. Customer does not think like that, and if you don't go by how the customer is behaving, you would assume that the more I spend, the more more freebies I give, or more I give him a lot of cash back to buy it, the customer will buy. But the real problem is that it is not because of that. It is purely because the product is not good enough, or there isn't a fit for the product or a service they are looking to sell. So as I said, the initial part of the growth curve is where you are going to sell your equity. So, and you will be coming across a lot of investors at this time. You will come across an angel investor, you will come across a Series A, Series B, and these are some investors who are specialists or experts in that particular stage of a life cycle, where they know how the company is and where they can give that money to them. So like someone like a Sequoia, they are very good at early stage. Someone like a SoftBank is very good at late stage. Then you get into the public market, where obviously you go to the public and say, we are selling this much share, and it could be an offer for sale, meaning that no new cash is going to come. The existing investors are going to cash out, Or the second one would be I'm issuing new equity, new cash is going to come into the company. Then you need to tell it in your prospectus what are you going to do with the new cash. It could be either for acquisition, it could be either for acquiring a new company, means acquiring new customers, expanding geographically into the new markets and all those things. So the first part is the seed part, which is basically I have an idea, and most of the time if I have good amount of work experience, if I have got good amount of bank balance, I generally don't go out to take money, and I use my own funds. But at the most, I can approach my friends and family. So this is the first stage where I'm raising capital. For entrepreneurs who don't have bank balance or money, they might go to an angel investor. So angel investor is again an investor. So he is not donating money for your relationship. He is donating money because he expects a return, and so you might need to get into an agreement. There is something called a SAFE, SAFE, which would mean that at the time I put my money, which is Y Combinator is very famous at that they actually came with this concept, is that I don't say that I need equity. You take my money, and when you go into the next stage for funding, I would require a equity at that point of time. And what that equity is, what the valuation cap is something that you will be deciding. But you will not be diluting the equity at the safe stage. But in Series A, Series B, obviously dilution does happen. So why do you do a Series A funding? Primarily because you want to acquire new customers. So you have a product market fit, you have done an MVP, and you have a prototype. You approach a customer, the customer says it's interested, but you need to put some more into it, some more either an R&D, some more additional features into it for me to pay you. So there are two things that can happen.
Sorry, you mentioned SAFE, right? Can you throw some light on why investors want to invest first and then get equity at later stage at a valuation? Which can be little pricier for the investor in the earlier stage.
Can you repeat it?
So, in a SAFE agreement, hello.
So, in SAFE agreement, investor puts the money first and then gets valuation at a later stage, right? So the valuation that he could get at the earlier stage can be little beneficial for him, right? Rather than at the valuation at a later stage, because for the same money, he's gonna get lesser equity at a later stage because the valuation is expected to grow.
See what happens, this is the big conflict between an investor and a founder, right? So see, when you start, you don't have any revenues at all. It's a pre-revenue stage. You don't even have any. So where is the money? There is no money at all. Whatever it is, it's at paper stage. Investors also know that if they have to get profitable, they need founder. Now suppose if I am a Y Combinator, I say that okay fine, I get 50% of their equity right away at a valuation, and I put some 100K or 1 million or whatever it is at an exchange of 50%. Then what happens is that the founder also knows that this 1 million is not going to stop. At later stage, he has to raise additional money. So at the first stage itself, if you dilute 50% of his equity, then the later stages his equity is going to come down and down. Why will he be even motivated to run the business? So you get into an entrepreneurship because you want to have control, right? Now what's the difference is that unless and until you feel that, again, not every company needs to go to a VC. If you are operating in an IT service market is highly mature. The customers are mature. Everybody knows how there isn't going to be huge growth. It's going to grow at an industry growth only, right? So in that case, why would you even need a VC investing? You go and then you try to capture that growth, and that growth is going to be more than what a TCS or Infosys does, purely because of the size. The base itself is slow, and second is you become very agile and their culture is very good, and all those things that will pivot you to a 100% or a 50% growth year on year. You take a VC investment only when you know that this investment is going to scale it from 1 to 100. So if you look at I don't know if somebody has read a book called 0 to 1. Yeah. So where he will say that you don't need to. The 0 means I am this stage. At the 1 means the stage that I want to be in. And not all startups need VC funding for that. You need a VC funding when you have a high TAM, and you know that if you don't spend money now, it's an opportunity cost. Then you are going to lose a big part of market share. You know why AI is why a lot of VCs are putting money in AI? Purely because of fear of missing out. They know there's such a big market, and this market is going to quadruple in years to come. If they don't put money, then they're going to be very late into the game. They are not going to put that money in an IT service market. So that's the reason why now at that stage, when I put my money, I am betting on two things. One is the founder, because he is going to execute what he promises, and the second is the market, where I feel that this market is going to go to a big level. Now, if I structure the deal in such a way that I take 50% at the start itself, then I am losing out on a big motivation. So it's better to have 1% of a 100 billion company rather than having 100% of 1 billion company. So you understood, right? So it's better you dilute your stake if you know that the company is going to grow bigger. So that is the reason why the Y Combinator has come. Lot of terms between investor and founder have become friendly now. So earlier it used to be not so friendly. So but VCs have also starting to realize that if they have to succeed, then the founder has to succeed, the entrepreneur has to succeed, and the leadership has to succeed. That's why you have the ESOP pool also coming in, where the key employees are also given stock ownership, because they know very well that the TAM is just a story, but execution part lies with the leadership. So these are friendly terms that Y Combinator has come into. And if you look at many companies that are in a big stage, Stripe is one. They're all been Y Combinator's thing. And the another part is that they give mentoring. So many founders, they don't know the mechanics of the market, and they don't know and the network. So they can connect you to a customer, they connect, and even the future VCs they'll connect you to. They have Sequoia, Anderson Horowitz, and all those guys. And if you feel that you have achieved your milestone and you're going to go to the next stage, and you can always say that was backed by Y Combinator, and there will be Sequoia who's willing to hear you. So another one thing that I wanted to say here is that having a good lead investor is very crucial. At that time, don't go for a valuation. So if I have a startup, and if someone like Sequoia is backing me, I am very confident that the next stage of funding, lot of VCs will come to me, purely because I have someone like Sequoia backing me. But at the first stage itself, if I start bargaining on valuations, then you're going to come across as not a so good VC. Like VCs also, there are a lot of VCs who are shady, they're not very credible. And you don't want them to be your investors. So as much as VCs do your due diligence, you better do diligence on VC also. Because a lot of VCs are frauds, and a lot of VCs, they claim to do a lot of things. Especially I've seen a lot of Indian VCs doing that. They say that I know Ambani, I know Birla, I know all those things. But when you talk to them, they don't know anything. Either they know the industry that they're operating in, they become a liability, and purely because in exchange of money. So raising capital is one thing, but also there are other soft benefits that you're going to look at, because you're going to be with him for a long period of time, and he's going to take a seat in the board, and he's going to observe your business. You give him certain rights to the ownership.
Sorry, one more follow-up question. For a safe agreement, would the equity come at Series A stage, or
whatever the next stage?
Whatever is the next. So in general,
the Series A is just a name that you call.
Right.
A, B, C, D, E, everything you can call.
Right.
So it could be even a next seed round, or whatever the next round. Right. From the safe stage.
Yeah, it's not often for it's very often for you to see safe agreement coming in picture after Series A, right? It's mostly prior to the angel or seed. So
safe coming.
Safe, yeah.
Yeah, fine.
So
see, angel and seed is something. It is not something consistent. If I have been in. If 20 years I've been working in an industry, and I've got good amount of bank balance, I don't even go to family friends. So I avoid the seed stage. I also avoid the angel investor stage. I go to the safe stage purely because of the mentoring and networking they give me. In exchange of that, they take an equity part of it. So the first is two stages, the seed and the angel stage. Many of them can even avoid it. Many of them can directly go to a Series A stage, which is the early stage investing stage. So you need not follow a strict sort of a process here. So now what happens in Series B, Series C, Series D is because the product market fit is there, you have got customers, so you are going to scale that business. Now for VC, why are they interested in funding your company? They are interested to fund only when they know that if they put 1 rupee, they are going to get 100 rupees or 10 rupees. That means the market is going to grow at such a high level. And for that only, the entire scaling, the capital for scaling is given. So when you scale, you burn a lot of cash, either through advertising, marketing, hiring people, or R&D. And that is when your Series B, Series C, Series D funding comes in. And once you have scaled up in a market, and then you see a competitor, like someone like a Facebook, it had a great social media company in that sort of a business of friends and family sharing. They were doing very well. Then something like Instagram came in, where there's a photo sharing started to come. Then there's a messaging platform that started to come from WhatsApp. Now what Facebook wanted to do is that they can't afford to go into these stages. But they have become a bigger company at that point of time. They use that money to acquire these two companies. They're more like a defensive acquisition that they do. So a lot of startups, before they do an IPO, they would have done a lot of acquisitions. And then after that, you get into an IPO stage. That's when you behave as good as any new company, where you publish quarterly results, you show the information to investors, and then you have to tell how much dividend you're paying, how much buyback you're doing, and all those things. So now, earlier in India, any company that has to list has to have a profit, but that's changed from Zomato. If you look at Zomato, Paytm, Policy Bazaar, many of these companies got listed in the market with no profitability or cash from operations. And there was a pivotal movement for the Indian startup, and that's the reason why people were finding very challenging to value a Zomato or a Paytm. That's the reason why many of these companies, the listing price and the current price is so much divergent. Whenever you have any new company coming in, investors will have very difficult time to value. It is not only in India. You look at Whole Foods that Amazon acquired. Whole Foods started as a first, many investors thought it is a discount retailer. Then it became something as a premium retailer, someone where you get a lot of health foods and all those things. So it started with a discount, and then people overvalued it. And then over a period of time, people understood what a company is capable of, and then the valuation became a little bit stable before it got acquired by Amazon. So any new company, because you're betting on the future, you really don't know what the sort of growth rate that you need to apply and what is the growth stage, because you also need to figure out in a valuation is not only the growth rate, but how long you're going to grow and how long you're going to get a return on your capital more than your cost of capital. These two things are very important. There is something called the competitive advantage period. We could say it is a cap in a valuation that it actually determines how good a capability in valuing the company. So someone who has valued Blockbuster before it got disrupted by Netflix was that Blockbuster at one point of time was a leader. It had a lot of rental stores. People assumed that they're going to build new stores, the growth is going to keep on coming. As and when you give more DVDs, the store is going to grow. So they were thinking that the $50-$60, the rate will go. But the moment Netflix changed the game, where they say that I don't want to have a new shop, I can mail your DVDs. And then they moved streaming. Then they realized that the entire CAP or competitive advantage period that they had assumed for Blockbuster changed. So you also need to look at the disruption, because your industry could be easily disrupted, or whatever business model that you are currently operating in can get disrupted. So the cap actually determines the quality of evaluation. Now, how are you going to get funds? Either you can sell your equity, you can borrow money, and there is a hybrid. I think most of them would have heard of Silicon Valley Bank, right? The bank that got doomed. And if you look at, the bank was very good at giving venture debt. So venture debt meaning that most of its customers were startup VCs and startups, and many of these companies they gave venture debt, which means that debt can get converted over a period of time, and there also the lending terms were quite different from a conventional thing. And when the funding winter came, so what happened is that the interest rates increased, so borrowing became costlier. So in that case, people wanted to withdraw from their deposits. When all of them started to do, it became a bank run. So and then bank got closed, shut down. And one of the reasons could be because it didn't diversify its depositor base. The entire thing where your borrowers were homogeneous, were not heterogeneous. But there are banks who do give debt. So venture debt and convertible debt comes here. And there is something called a hybrid, where you look at preferred. And when a startup starts, when we look at this S curve, right? The initial stage is when it is extremely difficult to value the company, because you really don't know what is going to happen to that company. So if you look at the survival rate of any startup, you have seen all these data, and 90% of the startups close within 5 years, 10 years, and all those things, purely because you are betting on the management, you are betting on the market, and if either one of these go wrong, then your entire money goes for a toss. So what happens in the early stage is that the valuation becomes a art, not a science, meaning that you have to show a lot of creativity when structuring a deal, and these creativity are shown in your early stage cap table. So you see a lot of preferred stock, liquidation preferences, participating preferred. Why all these things are being kept in your cap table is purely because they are protecting their downside, and so that's the thing. So as and when the company grows and it becomes self-sufficient, then valuation becomes a science. So in that case, you value a company based on EBITDA, based upon your growth, return on investor capital, reinvestment rate, and all those metrics you started getting into. At the earlier stage, the metrics may not even exist. For something like a .com company, it will not be even it will not generate revenues also. It will be like a hits, number of people, traffic in a website, the number of people who are hitting my web page, or if I'm an e-commerce site, then the number of people who are looking at my cart, how many times they are spending. Those become your metrics, because what you assume that if more people are going to spend time on my e-commerce portal, then there's going to be a conversion from that into a revenue. So in a pre-revenue stage, a lot of metrics may not be conventional metrics. The financial metrics come into place only when the company starts maturing. So now we have understood what the life cycle of fundraising. Let us understand from the perspective of venture capital what value creation means for them. And it's not only a VC, for any investor, someone who is also going to put your money in the stock market. When you are going to put your money on stock, rather than focusing on what others are doing, or rather than focusing on what the media is telling, you do some sort of an analysis. Okay, I'm paying this much money for a stock, and will I be able to get a return out of it? Is a company I'm paying too much for the stock? So all these sort of analysis comes when you do a value creation exercise. And someone who is great at it is Warren Buffett. I'm sure. And then Ben Graham's book. If people have not read it, I would suggest you to read it. One of the greatest books of investing, value investing, from The Intelligent Investor is a great one. And also look at Warren Buffett's notes that when he does the shareholder meeting. Basically gives you an approach, like what are the mistakes that the investors do, and why do you need to be patient. So if you look at the intelligent investor, there is a character called Mr. Market, meaning that your market will come daily to you and say, sell this stock, buy this stock, sell this stock. It's going to give you a price of every stock, but you should not get influenced on that. So you would have read Singh is the one who knows price of everything, value of nothing. So value investing is something that you should read, because that essentially is a template for the modern investing. The entire startup investing and your principles, those are first principles. And then if you don't look at value creation, basically you are doing speculation. So that's what has happened in Indian startup scheme right now. It has become a Ponzi game, meaning that I go and put a price, and I do so much marketing around that. We create so much buzz that I sort of create an environment for the subsequent investor to buy at a price more than what I have bought. It has nothing to do with the value. Basically, you're selling something for a higher price so that some idiot can buy that. So the entire thing is not value but speculation. But if you have to be really good at startup investing, because it's a riskier game, you have to read that book. It's a great book. Now, when you look at investing, there are two things that are very important. One is the risk that I take, and what's the reward I'm going to get for that risk. Now, only if I think that I can take a higher risk, then only my expectation for a reward should be higher. For instance, let us take a case of a fixed deposit. Someone like HDFC is paying me 7%, 3-year FD. Now, if someone tells me to go and invest in a Zomato stock, that is going to give me 5% return, why will I do that? If I know that the FD is going to give me 100% return, then there is no risk for me. With no risk, I am getting a 7% return. Why am I going to put a risk and invest in a stock which is going to give me only 5% return? So, when you do an investing, there are two things that you have to take care of. So, what's your risk and what's the return that you get out of it? And there are a lot of instruments that you can use, so you can fund your capital on. So, it starts from short-term treasury notes right till angel investing. Depends upon the appetite of the investor. So, someone who is very conservative will ideally put his money on a FD or a treasury bond, government bonds, because he doesn't want to take any risk and he wants to get return out of it. The only problem is that the risk is not there, but inflation becomes a big issue. Because what happens is that when you put a money on a bond, the rate is fixed. It is not linked to your interest rate. So the interest rate increases, your value of your bond will reduce. It has the inverse relationship. So though you will not have a risk of default, there will be a reinvestment risk, and also there will be a inflation risk that the all called as a pricing risk that comes. So depending upon your risk, your return will increase. So someone like a VC, they are paying a risk game, and they are also expecting a huge return. So no VC is going to put money saying that he expects 10% return. No, he expects 100% return. That's why he's going to put that money. So that's the reason for him TAM becomes very important. He is going to put money on a market that is going to significantly grow for the next 5 or 10 years. That's why you see AI having a lot of buzz. You see a lot of tech companies getting a lot of buzz, because it is very well known that tech is going to be disruptor, and tech is going to get your cost structure down, a productivity improvement. So I think I'm sure everybody knows network effects and marginal cost, right? So marginal cost would mean that if I have to spend extra money to manufacture or to sell a new product, what's the cost that I spend? So someone like a Microsoft, for them to sell a new license, their cost is negligible. For an automotive company to sell a new car, the capex will be very high, the cost structure will be very high. So tech is the only sort of where once your upfront investment is done, your marginal cost is as good as zero, is as good as negligible. That's why you have a network side effects kicking in from the demand side. It's not a supply side economies of scale, it's a demand side economies of scale, purely because more people use your product, meaning that more people will come, and people who want to acquire those customers will also come. So as and when more people use, you become bigger and bigger. So you don't need to spend so much money. Like Facebook is a great example of it. Is that that to become it bigger, it need not go and open new offices or go and open or even hire a lot of people. The only thing it has to do a lot of R&D to ensure that the stickiness of the customer remains when they are using a Facebook or a Meta platform. So for an investor, if I have 100 rupees, I have so many options. So there is no dearth of options for me. I can put it in a bond, I can put it in a startup, I can put it in equity. So, and second, entrepreneurs need to understand that there is a competition for that capital. It's not like you are the only person who is going to get the capital. If I put 100 rupees on the table, I can get 100 pitches from 100 startups. So there is a competition for that capital. Second is because the capital is a risk capital, it will change depending upon the macros. So that means if you have a high inflationary period where your cost of capital becomes higher, then the risk capital becomes scarce. Meaning that I am not going to put my money on a VC. I am going to put my money on a bond because I know that it is going to give me a good interest rate. So what I'm not even going to put my money in a 10-year bond. I'll put it in a 3-month bond or a 1-year bond because I can keep, because I know very well high inflationary period, the Fed is going to increase rates till the time inflation comes down, and it's going to be a temporary phenomenon. Not going to mean that for 10 years they're going to keep on increasing rates. So only for that period, I'm going to reallocate my portfolio to a short-term bond, being a 3-month bond or a 1-year bond. So the risk capital becomes scarcer when your macro changes. And these are purely what are the risk and returns that you get from each instrument. So someone like a startup, but I really also need to understand the risk. So if a VC puts money on 100 startups, ideally 95% will give him failure, but there will be one startup is going to give him 1000% return. So for every Google or a Meta, you will have hundreds of failed startups that a Sequoia would have invested in. So your decision to invest is a function of your risk appetite. So how much appetite you have for investing, what is the return that you expect from that investment. Third is liquidity. Liquidity meaning that if I want to sell, I have to sell. Now imagine someone like a VC. How can I sell that startup? It is going to go for a down, right? So where there is no exchange, like if the stock is not doing well, the liquidity is there in the stock, I can immediately sell it. For someone like a private company or someone like a startup, because I cannot sell it immediately, there is a liquidity risk that comes into that, and you will have to factor that into your valuation. Fourth is competence. Competence meaning that the more risky investing that you do, your circle of competence should be very high. So if I'm going to put my money in an AI startup, I as an investor need to understand the entire gamut of AI, how the market is going to shift, and what is the business model of the startup who is going to get my money. But for someone like putting my money in a FD or a bond, I don't need to know anything because there is nothing that I need to know. I know that okay, I put my money, I get a 5% return. So the risk investing requires a lot of competence and knowledge. Cost of capital. So a lot of Damodaran fans are here, so you know how you arrive at the cost of capital. But understand 2 or 3 things. One is there are 2 risks that you need to factor into when arriving at a discount rate for a startup. One is the liquidity, another is the marketability. Liquidity meaning that I have an ESOP. A company has given an ESOP for me. I cannot sell it immediately. There is a vesting period. Now, when that stock gets vested and get credited, I am not sure what is going to be the stock price. Today, the stock price will be 1000 rupees. But after 3 years, where my holding period is, where I am not allowed to sell the stock price, if it comes to 100 rupees, then it's a risk for me. So that's the reason if you look at a lot of big VCs, like a SoftBank and all those guys, they have a holding period even after the company gets into an IPO. When the holding period finishes, you will see a big block of stock getting sold in the market, and there's a huge stock that gets like a SoftBank I think sold a Paytm stock right now after the holding period got over. Second is marketability. Marketability meaning that what is the comparison? So someone like a small VC. Now, if I know that okay, Infosys is trading at 25x PE, TCS is trading at 40x PE. So I know I can compare. Okay, then means market is putting a higher growth for TCS than Infosys. What could be the reason? Is it because of renewal problems? Is it because of client concentration? For someone like a startup, there aren't any comparisons like that in terms of what the market is looking at. So marketability becomes an issue. So those two risks that you need to account it for a startup. And the third is that your WACC need not be very clear like an equity and debt. Your WACC will have a preferred stock, your WACC will have an ESOP, your WACC will have a convertible debt, and the risk for each will be different. So for debt, it could be a default risk. For equity, it is a cost of equity with a calculated by a CAPM model. For a convertible, for a preferred stock, the preferred yield will be the cost of preferred stock. For convertible debt, there are two ways. Either you can do an option pricing method, or you can separate the debt and equity of a convertible debt and value it separately and then add it up. So yeah, so your components in WACC will change depending upon how many instruments that you use for funding your company. Now, it's a very simple thing. So how do you create value? It's only then what's the cost of capital that you spend. The return has to be more than the cost of capital. Then you get an excess return. What happens if it is lesser? Then obviously people start selling their shares. Investors will withdraw their capital, and also your when the return is very high in the market, then it's going to invite a lot of competition. That's the reason why you see a lot of AI starting right now, because they're seeing a lot of returns in it, and the returns will slowly start reducing as more and more competition enters in, till the stage where your ROIC and WACC converges. And when that happens, you will see a competition moving out. It's a bit like a game theory. So when you come in and when you go out, it becomes a big important function. So your value generation capacity depends on how much return you generate from the capital, how much growth that you can achieve from the industry. So higher growth, higher ROIC, meaning that your value will be very high. So you look at all companies that are trading at a very high PE, they will be having both these into account. Somewhere like an Hindustan Unilever, where the growth is not very much happening, but you have an high ROIC, they are still trading at a 25x sort of a PE. But company that is growing a lot, but at a ROIC lesser than WACC, basically are destroying value. So it is better for that company to get out of loss-making businesses. So someone like a GE, who has spin it off into multiple, who have separated or divested multiple businesses, is purely because many of these were loss-making, and now they are focusing on one business, which is defense, and they know that they are going to generate a higher ROIC than WACC. So precedence is how much return greater than a WACC, and only if that is higher, you focus on growth. Otherwise, don't focus on growth. So if you look at cost of equity equation, it's risk free plus beta times the equity risk premium. So ideally mean that your WACC will be higher than risk free rate, and your risk free rate has to be higher than the inflation, because your risk free rate is a real growth plus inflation rate. So that is how the Fisher equation actually calculates risk free rate. So this is a nominal risk free rate, not the real rate. So nominal risk free rate, this means that risk free rate will have a growth component in addition to the inflation rate. Now there is something sort of a buzzword that has come recently, which is winner take all, meaning that you start into a industry which is a blue ocean sort of a strategy. You feel that you are the only one there, and before other people jump in, you put so much money that you grow and capture a lot of market share. So when you do that, the entry barrier becomes so high for the competition will not even get into it. Someone like Amazon has been great in it. So like they have been investing their money on such a lot of capex. Like it is very hard for a startup to even fight with Amazon. You need so much capital for that. But you need to also take into account this winner take all is a gimmick that has been used by VCs to dupe investors. What happens is that I show 100% growth year on year, but how do I grow? It's not because people want to buy my product, purely because most of them I give it for free, And when people get free products, they will buy a lot. That's the reason you keep on growing your company. Then what they say, it is growing at a higher rate, so it has to command a higher valuation. So basically, it becomes a sort of a selling pitch for a round financing. So if I, as a Series A investor, wants to exit and sell my share to a Series B investor, what I need to only show is that in 3 years, the company grows at 3-digit growth rate, even if it burns cash more than that. Because what I say that subsequently, at one point of time, when it has captured enough market share, the company is going to focus on profitability. Now, it is an assumption, but there is no path that a company has or an approach in terms of how do you approach profitability.
If the customer stickiness is shown, and as you mentioned about, if the customer stickiness is shown, and as you mentioned,
Thank you, Mike.
So if the customer stickiness is shown, and if as you mentioned, if network effects is also something which can be considered, and the lifetime value of the customer is shown to be longer, and if it is can be backed by historical evidence or other comparable companies, then it is okay, right? Even if
then the valuation is fair. Like if you have a customer stickiness, and what you mean by customer stickiness is that your customer acquisition cost will come down,
exactly,
and your lifetime CLV, customer lifetime value, will be higher, meaning the renewals will start happening. MRR will be generated determined by MRR and ARR, right? When that happens, means that there is a switching cost. The customer does not want to switch to another product purely because he has built certain amount of stickiness into it, and which you will not get in another product. So your cost structure comes down. You are able to generate cash flows very easily. Third is the predictability of the cash flows. You know that the guy is not going to move out for a long period of time till you get a new company which is offering a better proposition than me. So I can project my revenue. See, valuation is all forecasting, right? So when I have why SaaS models companies trade at a higher valuations? Purely because you have not only a recurring revenue, but also a predictability that comes into it. Because there is something called a churn rate. Meaning that someone like who is valuing Netflix, we ask to know that what's the churn rate, what's the renewal rate. That means what Netflix has 95% renewal rate, meaning that every year only 5% of them leave Netflix subscription, right? And that would essentially mean that they can do a lot of monetizing in the subscription itself, not the advertising part. Meaning that they can operate on multiple subscription models, and they can operate free family plan, lot of things. So if your customer moves out, then you really can't plan for anything.
So correct. So just to add on, as you mentioned, that if they are burning a lot of cash, it is okay if we could prove, as you said, that there's predictability of those cash flows. And LTV by CAC, the lifetime value of the customers increase, and also LTV by CAC also increase as such.
Okay, what happens is that you're earning the cash to acquire customer, meaning and you're assuming that the new customer acquisition cost will be low because stickiness will be high, because customer lifetime value will be high. So if you burn cash for that, then investors will not have any issue in funding that cash. Because what happens in a conventional accounting term, this is actually not a expense. This is a capital expenditure which has to put in the balance sheet. So one of the anomalies of conventional accounting is that a lot of your sales and marketing cost is not for the current year. It is for the growth. Like I acquire a customer and I always sell more to him, assuming that he will buy more from me, which is similar to a capital expenditure, right? I built a factory and I put lot of money, but I know that there are maybe 1,000 or 10,000 cars that is going to come out of that factory. So I know that there is an assumption that I put. Similarly, you look at a marketing expense or even R&D expense. So, but what accounting does is that it treats it as an expense. There is a reason why you get you see a net income negative in P&L. But if these companies actually turn out to get profitable, their ROICs will be 100, 120%.
Extremely.
Purely because you don't have anything in your balance sheet,
Marketing.
right? Because what generally happens, you put that asset into the balance sheet, then you capitalize that expense in the P&L, and then you have an ideal way that then you can compare companies. But because there are a lot of issues in how the current accounting is done, and I think what I've heard is that they are going to change the approach in terms of how they are valuing R&D companies. So please, now most of the companies that are right now are not capital intensive. They are all less capital intensive. You look at any company, be it except for Amazon, which invests a lot on capex. Even that capex is not on PP&E. That capex is mostly on R&D, and mostly there's someone who was investing a lot on blockchain. There's someone like Metaverse was a big investment that Meta did, but they are not your PP&E. So if you look at Facebook, you will see a big amount of your EPS coming down, purely because all those expenses are taken as accounting expense and not as a amortization sort of an expense. So you have to adjust your balance sheet accordingly if you have to do a right valuation of those companies. So what I'm trying to say here is that burning cash is okay if for why you are burning cash for. If your contribution margin is itself negative, meaning that I sell a good for 10 rupees, but I incur 12 rupees for incurring that good, then my entire business model is wrong. Why will the more I spend money, the more I generate revenues, the more loss making I'm going to become. So in that case, what I have to do, I have to stop and figure out how do I reduce the cost from 12 rupees to 8 rupees, so that at least I get a contribution margin from that particular sale.
It is a direct cost in the cost.
Yes.
Okay. So, one follow-up question, also relating to the post which recently we were discussed about the sales, right? The bookings, especially in e-commerce, future bookings are being considered, and you need to have some disclaimers. So, in this case, in our example which we were discussing on sales and customer lifetime value, do you think is there a loophole, or if I could say, some place for people to consider over and above sales, like over-the-counter sales that can.
What happens is that in IT company the business model is different. For a SaaS company, if something is you call a deferred revenue or unearned revenue, means you pay upfront, and then you get the good afterwards. For an IT company, you get a receivable, meaning that I sell on credit. So what happens is that I book my revenue, but I don't know whether I'm going to get paid or not, because what they say, I have a 30-day credit period. Unless and until the customer does not default, there is every chance that I will not get paid for what I have done work for. So there is a revenue recognition issue, meaning that I show my bookings. I say that okay, I've done my work, and I recognize 100 rupees. But the 100 rupees is not cash. It will take 40 days for the 100 rupees to come, because it becomes a receivable. And what happens if the 100 rupees does not come? It becomes 80 rupees. So I have to do a provision for it. Provision of customer not paying, right? And the second is that there is something called as a backlog in an IT company, meaning that I get a contract, and the contract operates in multiple SOWs, and so I have 100 units of work to be done, and I have recognized revenues for 10 units of work. So the remaining 90 units of work is there in my bag. That means customer has awarded me, but I have to still do that work. That means I have to still incur cost and do that work. So that big thing is a very important metric for investors, because they know that this much amount of work this guy already has. So if they do that 90 units of work, they assume that revenues will be carried forward in the forecasting year. Got it. So an IT company works differently compared to a SaaS company, or is compared to even an advertising company. Advertising company, it purely becomes like how much hit and how much and what are the metrics for monetization. There again, the cost is very minimal. If you look at a programmatic advertising business model, the entire advertising is driven by tech. So meaning that it's not done by labor, manual people at all. So your cost is very marginal. So whatever revenue is nothing but your cash flow.
Correct. Marginal cost is very
less.
Thanks a lot. Let's
get into the value creation side. in terms of now the value creation. Obviously, you have a management in the middle, and just imagine the two sides of the balance sheet. You have an asset side and you have the supplier of capital. It could be both debt and equity. What happens is that the company goes, imagine a startup, the founder goes to the investor, gets some capital. Investor will have some expectations. Okay, I'm giving you some money. What is the return I'm going to generate out of it? Then he puts that money into real assets. The real assets could be an IP, could be building a product, factories, anything. And he decides to invest that money in those assets, which is going to fetch him a return more than the cost of capital that the investor is demanding. Now what happens? The asset generates cash, so you get a cash generated from operations. Now after the company generates cash, there are three options for companies. One is it can return the entire profits to its shareholders and the lenders. So with shareholders, it can give dividends and buybacks. For lenders, obviously they are going to give them the interest rate returns. But if the company feels that there is a lot of growth it can do, then a part of the money is reinvested back into the company, which is called as cash reinvested in operations. And why a shareholder will give that company that cash? Because it is confident that the company will reinvest cash in those areas, which is going to give it a higher return. For instance, let us assume I invest in TCS, and TCS, if 100% of earnings TCS gives me as a dividend, then I get those dividends. Now what am I going to do with that? I'm going to again go and invest my money in any of the instrument. Now if I'm convinced that if I give the same money to TCS and TCS is able to generate a lot more return than what I will get when company gives the dividend, then only I have confidence in TCS. Then only I am okay with TCS reinvesting that cash into their operations. So that's why someone like a Google, who has never paid dividends in its life, shareholders are very happy because they know that Google is an excellent allocator of capital. So someone who is a great investor or someone who is a great businessman, he will be very good at allocating capital. I think that's the most important trademark if you have to earn money. So what's your capital allocation? So cash is reinvested back in operations, and that cash, if it generates a higher return, then the more cash will be generated. So which is called as the ROIC. So ROIC is nothing but what is the cash that you generate from those assets which are funded by the shareholders, which we call it as net operating profit after taxes. And what is the invested capital? What is the capital that has been given by the equity holder and the debt holder? And as a shareholder, how do I measure my yield? There are three ways. One is that I get a dividend. So then dividend by share price will give me a dividend yield. Then I can get something called a share buyback. Then I get how much buyback I get by share price will get a buyback yield. Now, if I don't get 100% dividend or buyback, that means part of that money is reinvested back to the company, meaning the share price has to increase. So what is the price appreciation? What's the book value appreciation? So that is I'm going to decide. So someone like, if I invest in a Google, I am not going to look at dividend or buyback. What I am going to look at is that how much is the price of Google increasing year on year, and that is only going to determine my expectations on companies like Google or a Meta. Now, different cycle for early stage companies. So now let us look into someone like a startup. So now, if you look at this one, you are returning back the cash to the investor, either through buyback or there's an increase of book value. But as I told you earlier, someone who does a temporary value creation, meaning that he is trying to increase book value superficially, where he buys assets. So when you buy asset, your book value will increase. But whether that asset is monetized or not, we don't know. So what's the cash flow generating capacity for that price. What I am saying is that I am adding the book value, the growth is happening, the growth is converted to cash is something which we don't know. So they say winner take all, but it has been a temporary value creation sort of a process, only except for a few companies where even Uber became very famous. The valuation became so high because they adopted this winner take all approach, that I am the only guy in the ride sharing thing, and I can also scale globally, and I'm not only a ride sharing, I'm also a logistics. So I'll be in every space which requires a transportation from one place to another. So it could be there. That's why they entered into food market, they into delivery and all those things. But that was the reason why the valuation was high. But were they able to create the value creation? Never. That's the reason you look at Uber. They sold their food delivery business, and also they are also not very active in India. Like for each market, a specific ride sharing company has taken over. So you have Ola for India, then you have I think what's it for China? It is Didi. Yeah.
So there has been a lot of discussion around should the ultimate goal of startups be creating value for investors or earning actual profit. So I'll take one example of Telegram. So it started in 2013. Currently it has more than 1 billion downloads, but it hasn't even earned a single dollar of money, and it is valued at 30 billion. So they are planning to launch their IPO. So how are these companies valued? Like the founders are raising more and more funds just to keep the app going, and still the company is valued at $30 billion. So what should be the aim of startups?
Essentially the conflict of interest. So anyone who is, that's why I also touched upon value investing, is that if you are investing with a long term mindset, then your interest and the shareholder interest and the value, everything will converge. But if it is for a short term, then there is going to be a conflict, meaning that I put 100 rupees, I immediately want 200 rupees, but that value is not getting created. So in that case, but I want to cash out and get that money at the expense of the final value creation that happens. So now for someone like a WhatsApp or a Telegram, the cash is not paid for monetization. The cash is paid for potential to monetize with that group of the base that you have, the customer base you have. For instance, if you look at Facebook or Meta, they are not directly monetizing the WhatsApp subscribers, but they are having intelligence on the data, right? And that data can be used for advertising purposes. So they are directing ads, targeting ads into the Facebook profiles and to the other sort of a thing. So it's a data monetization that happens and not a direct revenue monetization that happens. For Telegram, I'm not sure. But Telegram is a Russian company, right?
It's a Russian company.
Yeah. So now, what is happening right now is that if you are having only a messaging platform, if you are having one part of it, then valuation becomes not so greater than someone like where is having an ecosystem like a Meta. Like you can do everything. You can do an Insta, you can do a WhatsApp, then you have threads also coming up. Purely because as a subscriber, as someone as a user of Meta, I can get all the facilities. That is why if you look at the high valuations that these people pay, it's purely because they are buying time. They are not acquiring it for revenues. It's a defensive acquisition, meaning that they're ensuring that no competition comes to them. So that's even if you look at Adobe acquisition of Figma that they have done recently, they bought it for a huge price. That is not because Figma is, if you look at it as a small company and the multiples they have paid is very abnormal, but purely because people have started losing interest in Adobe, your editor and all those things. And the Figma is more like sharing and a lot of Canva, Figma and all those things, very easy. So they don't operate a license model. So all those things. So when they feel that they are going to lose their market share to an incumbent, to a competitor, then they pay a high amount to ensure that competition does not happen. It is a bit like a pharma company, right? You see a lot of pharma companies acquiring biotech companies. Why do they do that? Because pharma companies don't have R&D sort of a skill, or they don't spend a lot of money on R&D. Now biotech entirely spends on R&D, right? Now they get a vaccine, they need a pharma company to distribute that vaccine, right? If you look at your COVID vaccine also, your Pfizer only bought that German company, right, which made that COVID vaccine. So defensive acquisitions were very common in pharmaceutical space because pharma had the distribution, R&D was from the biotech, acquisition happened. The same thing is happening in the tech company right now, where you have a distribution with like an IBM or a Google, but they are not spending a lot in R&D. So the notion that Google is an R&D company is slowly fading. You see a lot of other companies, even OpenAI, it has not come from Microsoft or a Google, right? It started from a new company that they were funded by these Microsoft and Google and all. Then they acquire these companies and ensure that no competition comes in. So a lot of big tech acquisitions recently, the big ticket acquisitions have slowly started imitating the pharmaceutical acquisitions that are happening. Now you know this person, right? So and he is someone who has taught valuations to everyone, and who has made valuations extremely accessible to everyone. So if you look at before, you need to go to Harvard or a great business school, and those professors will not teach to other people. But ever since his YouTube channel had come, and ever since a lot of blog articles that he has written, he's had ideally enlightened a lot of people, and you see a lot of investors around the world. His most accessible data is the equity risk premium and the country risk premium. So because from someone who wants to invest in a New Zealand or in a Vietnam has to look at what the equity risk premium is. So those are the things, and he is someone who has talked about valuations in a very great detail, specifically on the discounted cash flow. So according to him, what he says is that when you sell an asset, you need to know the value of the asset. And now the value is something, when you say intrinsic value, right, nobody knows what an intrinsic value is. It's something like God, right? I know it's an intrinsic value because I am subjective, right? I say it's for 100 rupees. Real value nobody knows. And that's the reason why entire DCF is a hypothesis based. The fair value is something which is decided. That's why they say market is God, because everybody takes a bet and everybody are revising their expectation regularly from quarterly results and everything. So there is something called as a fair value or intrinsic value, which is something intangible. Nobody knows that. We are working towards determining the fair value, and that approach can have a flaw on two accounts. One is on the model itself will be a flaw. We have done some calculation mistake. The second would be the inputs that we to take it, and the third is that the inputs that we put in the valuation model are based on certain sort of an approach that what we think about the future. Nobody knows that COVID will happen, right? So if I value a company somewhere in 2019, I will say that someone like a cruise company or someone like an airline company will be next year it will trade at X rupees. COVID strike and all the airlines are lying idle, right? So there is a certain limitations in your projection, and so those are the risks that are very important when you do the valuation. That's the reason why you have to keep on revising your valuation. More you revise, the more you will understand about the company and the more you will become good at it. And always, it's my opinion is that it's the approach that matters. It's a thought process that matters. Or how do you look at a business? How do you look at an asset? It's not the end number that matters, because the end number is a culmination of your inputs and is your thinking. But ideally, what happens is that I value a company. People are interested in that number, and that number is not something is written in a stone. That number is going to be subjected to multiple changes. There can be a management change. There can be a customer leaving. There can be a macro situation change, etc. So I'll just give you an example of a market approach. So what happens in a market approach is that you don't do a cash flow at all. you say that there are multiple assets. Like a real estate is a great example of pricing, right? I buy a house. What I do is that I just see that what is the next house, what price it fetches, and there is a combination of multiple things, right? The location and the area, which part of the area it is in, etc. So pricing works much better in that. For homogeneous assets, pricing works better. For assets that are unique, where you cannot exactly say that both are equal, then you have to do a lot of regression. You have to calculate, you have to account for the differences between the two companies to arrive at a pricing. But all your IPOs, all your investment bankers, they do pricing. They never do a cash flow approach. So if you do all IPOs that are taken right from Facebook, Twitter to even recently, all your multiples or they look at your competition, they say these are trading at this much, and because the growth is very high, we are going to put this number of multiple. That multiple can differ. It can be a book value multiple, it can be an EBITDA multiple, it can be an earnings multiple, etc. So who values? Now, why you want to value a company? I as a founder, if I have to sell my equity, then I need to know what the value of the equity is. If I have to sell a house, right? I need to know what the value of the house is. Someone like a banker who is coordinating the entire buy and sell sale, he will be a person who will be interested in valuation. And these are similarly other interested parties are private equity, venture capitalists, etc. So now when you say valuation, as I said, it's not very objective. So even though the fair value is 100 rupees, but someone like I as a buyer, I would want it at 50 rupees or 60 rupees. So my objective is to buy that asset as cheap as possible. Similarly for the seller, he wants to sell it as high as possible. So even if you agree to a rate, which is a fair value rate, there is always an interest from both the parties to increase and decrease the price. There's a value and price may not converge at all. That's why beyond a certain point of time, human dynamics becomes very crucial in valuations. Because you have to understand the human side of it, you have to understand why the asset is important for the other side, apart from the valuation. The valuation is a reference point. And you have a lot of accounting principles that you need to take care of when you are valuing a company. So you have GAAP, you have got, there is International Private Equity and Valuation Guidelines. You can get into this website, privateequityvaluation.com. They would have detailed very clearly how do you value a company. And so what they say is that if you have an asset that is trading, then debt becomes a value. You don't need to do a discounted cash flow. Because what they say is that if there are 100 people, let's assume TCS. I do a DCF and say that TCS values 2000 rupees. It is trading at 3300 rupees. I cannot go and buy a TCS share for 2000 rupees, saying that boss, I cannot pay more than that. Nobody is going to sell a TCS share to me for 2000, right? So it is going to be the market rate. So if you have a market which is liquid and which is like something like a New York Stock Exchange or a Nasdaq, which is very liquid and where you have all great investors and where the buy and the sale is happening without coercion, and where as much information is provided for that specific asset, then the market becomes a important factor for the valuation. If you don't have a market, or if you feel that the market is not liquid enough, then you get into a discounted cash flow. Or if you have a distressed asset sale, where somebody is selling an asset not for the true value, but for some circumstances beyond his readiness, then you get into the cash flow approach. And then in the market approach itself, we have talked about pricing. In venture capital, there are some 2 or 3 known people, prominent people who have figured out their own frameworks. Some of them have become very important. One is Barker's method, purely when you get into a pre-revenue stage. When you are going to spend money on a company that does not have even a revenue, then how are you going to do it? You can't do a valuation at all. You don't know what the revenue is. Then there's someone called Barker's who has put a certain approach. There is a precedent method, meaning that what are the recent transactions that have happened specific to the one that you are investing on. You look at that as a frame reference point. I think Zepto is a very good example. They have become a unicorn recently and they have taken some funding. I am very sure that funding, whoever has funded it, would have looked at Zomato and would have looked at thinking that Zomato has increased its share price. They have, even though all this 2 rupees profitability and all is everything because of taxation issues, but still there is a there is a path to profitability, and Zomato has declared in their public reports that the biggest amount of growth is going to come from Blinkit. So taking all that into account and also looking at how Zepto has been performing over a period of time, they figure out certain valuation. So what I am trying to say here is a precedent or the list of transactions that have happened recently for that same company like yours plays an important role in valuation. And some venture capital uses scorecard approach, where you mean that there is a list of scores that they put, and then they identify what is the value that they have to pay. The second approach is the income approach, predominantly discounted cash flow approach, where you are saying that I am not focusing on the price, I am focusing on cash flows. So what is the present value of the expected cash flows would be the purchase price. The third is the liquidation approach, purely because where I say that neither the asset, like IP is a great example. IP, you don't have a competition, you don't know what are IP similar to that, because IPs are not traded. And the second is that if the IP has not generated monetized, then in that case you take the true value, you take say how much time and cost would it take for me to build the same IP, and then you figure that out using a replacement cost approach. So there's a gentleman called Burkus, and he was a great venture.
So irrespective of what valuation method you use, right? We saw in the previous slides that you had mentioned something about the lack of liquidity and lack of marketing. So how are we going to come to that rate of return that the investor requires?
It depends on the stage. So someone is at a early stage, some pre-revenue startup, right? Your hurdle rate is not going to be a cost of capital. Hurdle rate will be 80%, 90% and all. Because you're figuring, you are accounting everything into that. You are not only saying that I need to generate a return over the cost of capital. So what your cost of capital or cost of equity says is that what is the risk premium that I have to get over and above the risk free rate would be the return I expect from investing in equity for a public market. Now for someone like a pre-revenue startup, you are not only going to figure that out, but also include everything, which is that are you going to survive? Now there is now for a public market company, for a TCS or an Infosys, I know that it is going to be a going concern. It is not going to close down. But for a startup, I am not sure whether it is going to even survive over 2 or 3 years, right? So the survival rate, the illiquidity rate, the discountability rate, all these things will be taken into account, and also the final thing would be their whatever projections that they are showing, right? Their projections, there will be a huge haircut on that. So that is the reason. If you actually, I would suggest you all of you to get into those first principles of that valuation for private companies. What they will say is that when the deal closes, it's a transaction date. There will be a measurement date at the end of every year, and the transaction date and the measurement date need not converge. There is every reason that the startup will perform way poorer than what it has forecasted because of lack of product market fit, something the risk that it is incurring on its own. Second would be industry specific risk, like the entire industry is in a problem, or the third would be a macro risk. So based upon that, your hurdle rate will also differ. So I can start with a 50%, and if I see that all those risks, I can increase that hurdle rate also. But another thing that I also want to tell you is that don't, especially a good valuation will always take care of cash flows, will not take care of discount rate. You should not add a lot more thing in your discount rate. I think there's a big reason why you look at the VC startup ecosystem. The lack of transparency in that is purely because nobody knows what that hurdle rate takes into account. There's a 50% hurdle rate. Nobody bothers to tell me what is there in that 50%. This lack of transparency has literally confused both the investors and the founders in terms of valuation. Whenever you want to correct your valuation, correct your cash flows. Say that, okay, I am projecting this growth might not happen. And keep your discount rate. Risks that are not diversifiable are included in the cost of capital. That is the very simplistic thumb of rule is that any risk that you cannot diversify, you put it in your cost of capital. That's the entire WACC, the cost of equity and cost of capital takes that into account. How much, any risk that you can diversify, you cannot, that risk you can easily diversify. Why you want to concentrate your portfolio? That's why your diversification method is there. The entire drawback of venture capital valuation is that your hurdle rate. What goes into that hurdle rate, nobody knows. What they say at the start, I'll give you a 50% hurdle rate because I am taking all these risks into account, survival risk, illiquidity risk, all these things. Now, how much each risk is factored, nobody tells me. And what they say, okay, and the funding doesn't happen one time. The funding happens in stages. Right? So, you reach a milestone, you get additional funding. So, when you reach a milestone, that means that my risk reduces. That is why the early stage investing, the cost of capital will be very high. But as you progress to late stage, it will converge towards the public cost of capital of a public company. That is why even if you value an IPO, it is better that you take a cost of capital of a public company. Because eventually it's going to become a public company. So that's the thing. And the second part is that the risk. Now, someone like entrepreneur, where I have put my entire money into building a startup, I don't have any diversification at all. Right? So now the startup does well, I do well. The startup does not do well, I don't do well. So the risk, the sort of a diversification becomes the beta takes into account the diversification, that the risk, how much risk can be diversified. It is a total beta that I have to take care of, because the risk also includes the performance of the company. But when you take a levered beta or unlevered beta, it doesn't take into account the performance of the company. It takes into account the performance of the industry and the market. Like your interest rate will be determined by the inflation, etc. And in terms of how they are operating leverage and capital leverage. Like if you have more debt, then you need at the time of distress, your lenders will take over the company. So as an equity holder, I have a lot of risk. And at the same time, if my company is capital intensive, if it is cyclical, then I have to incur a fixed cost even when even my revenues are not coming in. So a variable cost is low here. So those things are taken into account when you calculate the beta.
So if I'm looking at a public company who is acquiring, say, a smaller competitor, so say Zomato's acquisition of Blinkit, how, if I have a standalone valuation of Zomato, which is fine, I do it based on the DCF, I have all the projections. How do I then factor in, say, the valuation of Blinkit? Because if I do a peer comparison, each peer is at different stage, right? Zepto is probably just a 3-year-old startup. Grofers is, much more mature in terms of their business model. So how do you typically, value such companies? And additionally, there's no, peer in the public listed space with whom I can sort of compare the valuation. So how do you, value these kind of, when a existing public limited company is pivoting and, acquiring someone in a related space?
Okay, first is you do a pricing. And when you do a pricing, as I said, as you have correctly pointed it out, there are differences between the companies that you are comparing to. So you cannot do an apple on apple multiple and say, boss, this is doing a X, so multiply by this and you get it. This is not a pricing. You have to account for the differences. And the second is that those differences need not come out from the financial drivers, like when EBITDA or a net profit or revenue, can also come from industry specific operational drivers. That meaning that if I'm calculating Blinkit, then what's the delivery time for me I order and how much time I get in. So if it is 10 minutes, if I the quicker I do, that means I have a chance to acquire more customers. Second would be that how much dark stores I open. Dark stores are capex. So those metrics are also used in conjunction with the financial drivers to arrive at the pricing of that company. There is something called discounted cash flow also, where what you are saying is that I am putting a growth rate. Like for instance, Blinkit, I am saying 20%, 50% it will grow year on year. It means if I have to grow it 50% year on year, then where does my cost come into? Am I going to hire more drivers? I am going to open more I am going to open more dark stores. I am going to expand my SKUs. SKUs become a big thing. So now they don't sell everything, right? Like what SKUs here that are there in Big Basket, it is not there in Zomato or in Zepto or Blinkit. There are fixed level of SKUs. Keeping that in mind that these are the important things that they will want in next 5-10 minutes, which are milk and other things. But over a period of time, when this becomes a main thing, then they will have lot more SKUs coming into it and opening new stores. So your entire business model comes into picture when you do a valuation. So in that case, where is the additional money going to come from? So someone like
open new stores and capex also goes up.
Absolutely.
Right? So your DCF gets
correct. Now your capex increases. At the same time, what's the profitability you are going to get from the dark store, from opening a new store? How much growth is going to come from there? And because you open a new store in an area where you feel that there will be a demand. So first you have to identify an area, and then you know that there is going to be a lot of demand, and then you need to ensure that those dark store it's the right distance from the customer so that the travel time gets reduced, and those metrics are taken into account when you do a discounted cash flow. Then you assume that okay, fine, I take that everything into account. Then I pay this much for driver, I pay this much for opening dark stores, I'm opening this much for maintaining the dark store. How much money I keep it to myself? That excess money will be your cash flow. And that is where discounted cash flow requires a very detailed understanding of business fundamentals. But if you do a pricing also, you are actually doing that, but you are not very explicit about that. You are just saying dark store, that's it. You are not saying, but you don't get deep into that, why you open a dark store, what all you should keep it in a dark store, and all those things. So even if you keep it Zomato, right, there is something called cloud kitchen that has come in, which meaning that they don't even go to a hotel, or in Zomato also, they also buy groceries for the hotel restaurants also at a lower cost. So they are hitting the restaurant market in all ways to ensure that they get more money out of it. So when I do a valuation of Blinkit, there are two things I have to take into account. One is understand how this market is, and then see how much value that I'm going to capture out of this market that Blinkit will capture. The second part will be the synergies, which will be how much Zomato as a standalone ecosystem will be able to help Blinkit from its existing investment, from its brand, from its existing user base. So for instance, if I am a Zomato subscriber, or if I buy regularly from Zomato, then there is every chance that I also buy it from Blinkit. If Zomato app itself, you can go to Blinkit. So your existing customer base that Zomato brings in also adds value to Blinkit. It's a very important asset for platform companies, which is basically the number of subscribers that they have. So that's why somebody like Amazon or Facebook, they're able to move from one business to another, because they know very well that past subscribers who are very sticky will also move towards them. That's why you have your you buy from Amazon online commerce, but you're also a subscriber of Amazon Prime also.
But how do you quantify that?
Quantification, as far as possible, there are only three drivers. These are operational metrics. One is the growth. How much, if I add dark stores, how much additional orders that I'm going to give, which is quantified by the revenue growth. The second, which is what is the profitability I'm going to get, which is EBITDA, will be the now that profitability will differ. The driver will differ from each business model. For it would be what's the profit per order, how much order. The bigger the order, that means the lower the delivery cost and the higher the margin. The third will be the turnover ratios, meaning that I buy an asset, then how much revenue I can generate from that asset. So the more revenues, the better it is. So if you look at ROIC, is nothing but NOPAT by invested capital, right? Now NOPAT is nothing but NOPAT by revenues into revenues by invested capital. You just put that. So NOPAT by revenues is after tax operating margin, and sales to invested capital is nothing but your turnover ratio. So both combine to give you a better ROIC. So either you can improve your pricing, reduce your cost to improve your margins, or you improve your turnover and obviously the growth. So in any company, those are going to be the three factors, but every company is different. So the metrics to arrive at will differ. For an airline company, it will be different. It will be a seat mile. For e-commerce company, is different. For a subscriber-based company, it is a churn cost and your customer lifetime value. But everything broadly at the end translates into three things only: revenue growth, after-tax operating margin, and your turnover ratio. And the final is the discount rate, because you have to discount the cash flows from the future to the present. Those are ideally the four value drivers in a valuation, but it differs from industry to industry.
As you mentioned on the IAIP guidelines, we discussed on size, growth, profitability. The size of the turnover and growth would be the last few years of growth, and profitability, what would be the EBITDA margin or what would be the operating margin. So that would be the analysis, right? That is where we look at comparable companies and we see what is our company amongst them, and then find a commensurate multiple. And second, would another approach of transaction approach, even that would be a feasible.
That's what I told. Because every company is not an apple to apple comparison. For instance, let us assume a TCS, which is a 20 billion revenue company. It grows at 10% year on year. Yes, let's assume a small company or a mid cap company that is not even a billion in revenues. It might grow at 20% year on year. So TCS and that company are not year on apple to apple comparison. Size matters a lot.
Correct.
And so when you do a pricing, it is very important you take that regressions into account. And that differences, that's why you do a regression analysis when you do a pricing. Because it will account for those differences. You cannot say, okay, I take one company, because then it becomes very convenient for me. I will only compare that company which I wanted to compare. Because every company is different, right? One company is trading at 100x. Then if I as a seller, I say this company is trading at 100x, I also want 100x multiple. But there is a reason why it trades for 100x.
You need to take the discount.
Yeah, you need to take the difference for it. So why it is driving at 100x? There could be a capability difference, there could be a size difference, there could be a customer difference, geography difference, multiple differences. That's why discounted cash flows are far more comprehensive framework, because you take all those assumptions when you do build a model. You don't do that when you do a multiple, right? So lot of that are not explicit, it is implicit. The same applies for precedent transaction also. So what you do is that, okay, last year or next 3 months back, your competitor has got acquired for 20x multiple. So I also need 20x multiple. That cannot be the argument, because why he has acquired it for 20x? There could be synergies into play.
DLOC also.
Yeah. So there will be something that the customer wants from the target company which you don't have, and that 20x multiple excludes synergy or includes synergies we don't know. So these are all only a reference point, because what happens in discounted cash flow is that you get into a range. You don't know that this is objective value out of it. So these precedent transaction and comparables give you a reference point, so that you just shorten the range.
Corroborate the DCF. Got it. One last question was on the itself, where you mentioned on DLOC or you mentioned on synergy benefits. Do we kind of have a list of things which we should consider when we are discounting a comparable or precedent transaction multiple?
Depends on the multiple that you take. If you take an EV to EBITDA, then what are the it's something called as a correlation in statistics. Is that price to earnings is a multiple that you take. Now, price to earnings is nothing but a function of your revenue growth, your cost of capital, and your reinvestment rate. So when you do a regression, dependent and independent variable, you need to take these independent variables into account and do a regression. And also you need to look at the R square. What's the correlation? If R square is very less, then that regression does not work out. So R square ideally should be around 70-80% minimum, and the T statistics has to be relevant.
Got it.
Yeah.
Sure. Thanks.
So what multiple you choose to price a company would depend upon the regression also. So there are certain multiples, enterprise multiples are far better than the equity multiples, purely because equity
Capital
multiples
structure.
doesn't take into capital structure.
Got it.
So debt is not taken that into account.
Got it. Thank you.
I just have one question. Basically, when we say ROIC, if there is a capex which is there, ROIC will be impacted for that current year.
Absolutely.
So how do you normalize that when you are taking a decision at that point in time?
That would depend upon what is the capex cycle of that industry. Let us
No,
assume
but if there is a growth capex that we are doing,
I'm saying only
let's
for
say-
growth capex. Now I invest in let us assume an automotive company. I open a factory and I do so. At least 2 years I spend money. Revenues are not going to come immediately, right? So it will take another 2 to 3 years before the revenue starts kicking in. In that case, you have to look at the capex cycle and normalize the capex accordingly, because otherwise what used to happen in that specific year, the capex will differ. Your sales to investor capital will come down.
and that will hamper
Yeah,
the
so when you're
decision-making.
projecting, you have to take that into, that's where historical records will take, historical financials will help you. Like someone like a Tesla, I know that if it has to open a plant in India, it will take it has to finalize on a land, buy equipments, buy assembly and all those things, build assembly. It will take at least 3 years for it to, revenues to start kicking in, for it to start selling cars. So in that case, what's the normalization that I would do? So when I project it, I have to normalize that sales to invested capital.
So it is not very easy to get to that normalized ROIC.
That's why I say that understanding of the industry is very important, because someone like a oil company, where I do all sort of oil drilling, exploration and all, and for me to oil to come out of the surface and to sell it, it will take 5 years, right? So in that case, I cannot take the capex turnover at the time when the wells are drilled. So in that case, what happens is that there is something called the value of new asset and value of existing asset. Your existing asset continues to churn out revenues. That your existing oil fields are churning out revenues. Your newer oil cycle will take a long time. So the industry per se, you have to normalize the ROIC. For mature industry, it works out very well. And another thing also you want to understand is that nowadays for tech companies per se, the capex cycles are reducing. So like for instance, like a SaaS company or fintech company, what's an R&D cycle? Not more than a year, right? I do an R&D, I immediately get revenues out of it. So in those companies will not, you will not face a lot of problems.
that it is not impacted in the long term.
You will face these issues in utility companies, companies that have huge capex cycle, or even trucking companies, right? When you look at trucking companies, there comes a point of time where it has to replace its fleet. So at one point of time, its ROIC will be very high because its asset would have depreciated.
Yeah.
But at a single year, its ROIC will go down purely because it's replacing the existing fleet with a new fleet. But that does not mean that the company is going poorly, because that capex is going to improve the performance of the company over a future period. So that's why I say you cannot just put an Excel and extrapolate those rows and thus drag the rows. You have to understand the business, you have to understand why they have invested, and what will be how much time it will take for the investment to get monetized. So whenever a capex takes place, even acquisition takes place, it's very important to understand why they have acquired or why they have initiated in a capex.
So suppose, Mr. Ram, so if basically if we are valuing a company and let's say an Indian entity driving revenues from US, and let's say it's an export business, what is the WACC that you will consider for valuing that kind of a business? Whether it will be a US WACC or whether it will be an India WACC?
It depends upon who its customers are. So if it's
So I'm
purely
saying
US customers, then
US customers, but everything, the delivery system is there in India.
No, so in that case, where the risk is higher, the risk is higher from your employees not you're not able to get good employees. Your risk is more from your customer churn. Like for instance, my relationship is with FedEx. I'm supplying some software to them, right? Now my WACC will be dependent on that US company. That is the US WACC. I will take that into account, not the Indian WACC, because the biggest risk is because what happens if FedEx does not continue with me, and what happens if FedEx continues with me? Now take the inverse case. Take the case of an oil company, right? So I am working let's say ExxonMobil, which is an US company, right? but where that oil fields are in Africa region or other regions, right? Where there is every chance that the oil drilling cannot happen because of civil unrest, etc. So in that case, they cannot take the US back. You have to take that specific back. So WACC is nothing but a risk. So risk, where is the risk coming from? Is the risk coming from your customers or risk coming from your supplier? If your risk comes from supply, then take that supplier risk. Comes from your customer, take the customer risk. Or the risk, if you feel that the allocation will be equal, something like an automotive company, like where I build a plant in UK and I also sell cars in UK. So in that case, I can take the entire country back. That's why you have country risk premium also. So because the country where you do business in becomes an important factor in you arriving at equity risk premium.
So, for example, my company, it's based out of India, but wholly and solely catering to US clients, right? So my customer risk is on the US side, right? But the whole point of setting up the plant here in India or having the employee base here in India, suppose say it is a software company. So it's not a capital intensive company. It's a company which is based on its employees, right? Now the whole idea of setting up my base in India is that the labor available here is cheap, right? So when an investor, he has his entire base here, just that its clients are in US, wouldn't the investor expect the return which is available in the market in India and not in the US?
Because why do you say like that? Because your entire returns is driven from the US dollar rate, right? What is driving the arbitrage? Arbitrage is nothing but the exchange rate between US and India and the labor cost, right? Now, if both narrows down, let us assume that I don't need the labor cost at all. Entire tech is can do. Like let us assume tomorrow AI does everything. Why do I even do outsourcing? First thing. Second is that also the only thing is that if the availability of skill is extremely unique, then only India caters to that, and not the other, not like a Vietnam or Philippines or any other thing. Then you can take India as a country for arriving at the risk. Otherwise, the biggest risk is that for an Indian company, is that what happens when customer does not spend. So the risk is more on the customer side, not on the Indian side. And you are doing valuation of the Indian company, right? You're not doing valuation of the US company. Right. From an Indian perspective, I can always replace the Indian resource with another Indian resource. So okay, they're asking me some hike. Okay, I can give it. I can, but at any point of time, I can improve my bill rate. As long as I improve my bill rate, then I can always increase my the labor cost. But what happens if I'm not able to improve the bill rate at all? Or what happens if that country, Poland, sort of a country, then the risk is very high, right? So that's the risk that we have to take that into account. So it's a customer specific risk.
What he is saying again over there, when you take the hurdle rate will be of an Indian investor.
And hurdle rate will be for US company, I'm saying.
So why will an Indian investor invest in an Indian entity with a WACC of US? That does not make sense for me.
Why will an Indian company invest in?
So let's say if I am an investor, I am investing in an X limited in India, having operations in US.
Correct.
Well, my return expectation will be as low as 10-12%. It will be the Indian return.
No, but you are also looking at the inflation also, right? So there are two things that you are taking into account. So equity risk premium will have country risk premium as US. So there will not be any default risk for because the entire operation is happening out of US, not in India. So you will not have this country risk that you will factor in for India. At the same time, you are also taking that into that will also nullify the inflation also. You are taking it will when you do that into the discount rate, it also settles into the cash flow also. So what is driving higher rate for India? Is it because of the growth or is it because of inflation? I think it's because of inflation, right? It is not like if you take that expected inflation plus expected real growth. Expected real growth will have a minor component. It is the expected inflation that is increasing, right? When you actually go and that's why a company like TCS are far more stable. It is not volatile at all, purely because its customers are stable. Inflation is very stable there in US.
So are you hinting that when we do a WACC for discounting this entity, we will converge to
if you take the WACC of an Indian company, then you will undervalue TCS because your discount rate will be very higher. if you like, let us assume for a chemical company operating, or Tata Chemicals is operating at 13% WACC. If I am going to put the same 13% WACC for a TCS, then I am putting a higher discount rate. Then TCS will always appear far more costly to me than what it is. Right now, if I say no, TCS does not demand the 13% sort of WACC, it is only 8 or 9%. Right, that means then you will find TCS normally priced or fairly priced. But otherwise, if you are going to put the Indian a company operating out of India that is sourcing entire revenue domestically, if you put the same WACC to an export company, then you will find every export company highly priced. That's why you always find an Infosys or a TCS fairly high price, because discount rate will be very high. If you are putting it for a for a Tata Chemical, or where the entire revenue, even for Tata Steel, a big amount of revenue comes from UK. Tata Motors, big amount of revenue comes from Jaguar Land Rover, right? So there are very few companies, because of globalization, there are very few companies where the entire revenue is domestic, 100%, right? You're still scattering out. So in that scattering out, it's always better to find a weighted average of the country risk premium. That's what I'm trying to say. It will give you a far better flavor. Otherwise, what would essentially happen is that someone like Embraer is a Brazilian aircraft manufacturer, right? And all its customers are US customers. Now, Embraer operates at a very high price in Brazil because it's the number one aircraft manufacturer. But if you put a Brazilian oil company discount rate or a chemical company discount rate to Embraer will always you find it trading at a higher price, because the discount rate you are putting is very higher. You have to look into that account, is that where the customers are in, what sort of volatility are here, what sort of inflation are here. I am operating out of a US market which is extremely stable, so my risk will be very less. At the end of the day, discount rate or a hurdle rate is not what you expect, is what is the inherent risk of that business. You might even expect 30% expectation. It is not about what an investor expects. It is the risk of investing in that business. What is the inherent risk in that business? You cannot say, because I am an Indian investor, I want 12% return. So I want TCS, WACC also I'll put it 12%. No, TCS risk is extremely low, purely because the risk factors that it faces working with US customers are very low. The volatility is very low. For Indian companies, there could be a regulation issue, there could be strikes. There are so many country-specific issues that India has, which is essentially helping you to put inflation also breaks into a big account. So all those things. So if you want to fine-tune the evaluation, it's always better to look at which countries you operate in and where the risk levels are there. So risk level need not be like, for every company you need to you should not look at customers. It also depends on what industry you are in, where the risks are higher. Is it on the supply side, is it on the demand side?
Revenues are coming from a very stable country, but you are operating from a very unstable country. You have to put the risk premium for that also, right?
Depending upon which, how much of that is responsible for overall operations.
For example, let's say the inflation rate is very high in India. Okay, inflation rate in US is low. And the situation, the law, regulation, the condition. I agree with you that you have to put the WACC of US, but you have to add the premium, because you are also operating from a country which is unstable.
That's what I said. So it is not, everything is not hard written. If you feel that a big part of risk comes from the supply side also, if you see India as an extremely unstable country, where you might not know tomorrow a war can come and it is similar to a Sudan or a Syria, then you have to take India risk also into account. But if you feel that India is a fairly stable country, regulatory policies are not going to change, the government is not going to seize an India IT company, tax laws are not going to change, it is extremely business friendly. So in that case, you have to essentially take the account of the customer risk.
Yeah, exactly. So what I think that it's more kind of a art, science, experience.
Absolutely. That's what I told you.
That will drive. Okay, there is nothing black and white that
Yes.
this or that 10 points are written, tick boxes.
Not at all.
I don't think that works.
Not at all. That is why someone who understands the industry very well will be doing a far better valuation of a business than someone like an equity research analyst who is just job is to just do the numbers and read the reports, because he understands the integrities of the business. He understands where the risks are coming from. If I am an IT company and I know that inflation is driving so much that I have to give 10-20% hike, I am not able to get quality laborers into account. Then in that case, when I calculate the hurdle rate, my calculation is, that's why you look at Warren Buffett's book. He doesn't believe in this Kappa model at all. He says that someone like a Coke, where the revenues are so stable, where people buy it for brand, not for beverage. Why should I put a risk of 10% for Coke? Risk is so less. There is nothing that affects Coke at all. So he puts a risk-free rate as a discount rate. So,
Exactly.
If there is nothing black and white in valuation, you need to substantiate your logic when you put the numbers. And that comes on the function of your experience, competence, and also how you look at the industry. And it's not like you will always be right. You will be wrong. At that time, you always revise your valuation.
I think this is something which we had discussed in one of the posts actually. We've spoken about this Tata, let's say Tata Automobile engineering, the plant was removed from Bengal to that of Gujarat. And that is an operation risk from the supply side.
Significant risk.
So that probably could be added premium. But when you mention about this IT employees, let's be honest, there's a lot of demand, a lot of supply, and it's not a problem as an operational company, as an IT company. There's no problem as from the supply side of it. So even though my company is in India, it is not a problem if I'm catering to US, because US risk is more prevalent.
I get it.
More and more IT companies are going to tier 2, tier 3, offering work from option. Because if someone from Bangalore is demanding a higher salary, and if I feel that he is taking living conditions into account, then I say, I don't want you, I can do and operate in a tier 3 city where the costs are very low.
So I was mentioning that there should be a premium for unstable countries. So just to add on as an example, if we have a same software company which is based in US, has US clients, and we have other example based in India, has US clients. So the WACC probably in India, for example, would be 9%, and the WACC for US company, US clients would be 7%. So we can, it is okay to say that the 2% is a premium for operating from an unstable.
Change, right?
Yeah, that's what.
Your risk-free rate for US is different. You take a treasury bond as a risk-free rate. For India, you take a government bond also into account, which has a default spread.
So that would be risk for operating from an unstable company. That is good to say, right? Unstable country, right? Yeah. So that is,
it's not an operating risk, it's a country specific risk.
Okay. So that's what unstable.
Yeah, because inflation comes into account.
Yeah. So when comparing US and India, India is more of
US company, a company headquartered in US, having a US customer will still have a lower risk than an Indian company operating in India having US customers.
So that's
but Indian company operating in India having an Indian customer will be higher risk than an Indian company operating in India having a US customer. Now the risk quantification is something, as I told, you have to understand where the risks is coming from. Is it from the demand side or the supply side? It's not like you put in a number and it will be same for all the sort of companies. For an automotive company, it will be different, right? Because I have to go and put up a plant there. If I have to build an automotive company, I can't transport cars, right? Like a Tesla, if he says, okay, I'll just export cars from Tesla to India, then it is not going to work out. It has to set up a plant, it has to manufacture cars and then sell the cars. So that becomes a difference. So for IT company, it's not like that. I can still deliver the service to a US customer operating out of India, because it is not a big capex that I have to spend upon. So that's why I said, it's not everything written in this you have to do. The more and more you understand the business, you will factor the risk accordingly into your valuation. Okay, so this gentleman, Dave Burkus, he gave us the framework for called as a Burkus method, and this is purely for valuing pre-revenue companies, means the companies that have even not started generating revenues. So in that case, how do you value such companies? He has some 5-6 points. What he says is that the company must have a sound business idea. That means the idea has to be good enough, and which is a function of TAM, which is a function of product market fit and all. Then the quality of leadership. Does the leadership have the capability to execute that idea? The third will be that what is the demand of the product, which is a function of technology risk. And then does the company already have built some relationship with a customer or have an alliance? So which is a function of market risk. And then if it has to manufacture or if it has to deliver, are there distribution channels and are there production built framework? That will be the production risk. So he awards a certain number for each of the characteristics and says that not more than 2.5 million has to be paid for a company that has not yet started its revenues. So he caps it between 2 to 2.5 million and says that only if it satisfies everything, you put 2.5 million. If it doesn't satisfy even one thing, you start deducting the valuation accordingly. Just a framework, and then it is not like you have to do 0.5 million, but important thing to know that you need to take these drivers into account when you value the company. Like you know that there has to be a market, the leadership, etc. We have already discussed about comparables. So as I said, what multiples that you use for pricing companies are different. So many companies use enterprise multiples, EV to EBITDA. Some companies use equity multiples. Some companies look at EPS price, and also some companies look at operational multiples. Like someone like an oil company, it all depends upon how much oil you have and what's the price of the oil. So that will determine the commodity risk, etc. So and also it depends upon at what stage of the life cycle you are in. Someone for a early stage company, operating drivers can be a good assumption. As you become more mature, it's the financial drivers that are more crucial. Just an example of a GoPro. GoPro is a you know it, right? Yeah. So how do you value GoPro? So you just take an EV to EBITDA. It's a very normal as you do. What are the comparables? What is the EBITDA of that company at that particular year, and what are the trading multiples? Arrive at a 6x and say something like this as a valuation. Precedent, as we have already discussed, what are the recent deals that has happened in that specific industry, and you take that into account, and also you have to look at how did they value those deals? Is it on the EBITDA multiple? Is it on the PE multiple, etc.? And then there can be one of the reference point. And it's always better that your precedent multiples are as latest as possible, because it loses relevance as it exceeds a certain threshold period. So I can't compare an acquisition that happened 5 years back and say that company had a multiple. So because markets change, things change, companies change, etc. So it's better that you restrict your precedent transactions at least to 1 year or 1.5 years. But if you don't have lot of acquisitions happening in that industry, might be you can extend it for 2 years. But in like tech acquisitions and all, not more than a year, you would want to do a precedent transaction analysis. Scorecard valuation is nothing but a combination of workers and comparable pricing. So you take a comparison pricing, and then you also assess the metrics of that acquisition that happened with your target, and see that how is the target performing in comparison to the company that had acquired, and then you revise your multiple accordingly. So for instance, these are the Burker's drivers that you take, and you arrive at this multiple. Then you also look at the recent transaction that has happened. You compare that transaction with those drivers, and then you arrive at a multiple, and then you say that this valuation will be around 80 or 90% of the present valuation that has happened. So if it is 13 million that a company has got sold in, you will say that I will not give more than 11.5 million. It's all just a framework approach that you follow it. TCF, I think we have discussed a lot. So I'm just going to run through these slides. So what is free cash flow to firm? I'm sure that everybody here, I think they understand DCF a lot better. So now what's the cash flow from operations? Then you invest something, which is the cash flow from investment, and where the money is coming from. So if it is if you have taken a debt, then interest becomes your expense, and if it is from equity holders, then you have to fund dividends and buybacks, etc. So these are three important financial statements: balance sheet, income statement, and cash flow. So earnings and profits are not equal at a specific year, but over a period of time, earnings and cash flow has to converge. So meaning that I rent a car, I buy a car. So now if I rent a car, what I mean that I only spend money on renting the car. So in that case, I don't put it on a balance sheet, and I get some earnings out of it. I buy a car, so I do an investment. But at the end, I'm not, because I'm not renting it, I'm losing. I'm not spending anything on that expense. So your cash flow will differ. But what you will do, you will depreciate that asset for a certain period. When the depreciation is over, your cash flow and your earnings has to converge. So may not be at the starting, your earnings and cash flow need not be same, but over a period of time it has to converge. Why you do discounted cash flow? Purely because of inflation, present time value of money, present value and future, all those things. I think I'm very sure you know it. Is just an example that I have given, that let us assume that I have taken a mature company, and how much cash flows that I can get out of it. For something like a mature company like a Tata Steel or ITC or anything, you don't say that okay, only for 10 years the company will run, right? You can at least forecast at least 30-35 years of revenues. So you project the cash flows and arrive at the discounted cash flow. For startups, because there is a survival risk, you don't do that, and you basically stop at a certain period of time. Replacement cost, as I have said, assets that neither do have comparables, and neither are able to monetize their asset. It is better to value using a replacement cost method. So what you consider a multiple thing. You consider what is the tangible asset, intangible, what are the labor force. So that you want to acquire a team which is very good, though the team might not actually generate a lot of revenues. So a lot of acquisitions happen because they just want to take the team entirely, but the team is going to add value. So those are all your the replacement cost thing. And as someone said right away that what happens to these big tech companies is that the more and more they do not allow the competition to prosper, the entry barrier keeps on increasing. So someone as a new competitor, he cannot compete with a Microsoft or a Google. So you become a monopoly or an oligopoly, and when that happens, you have the decision to set the price. And when that happens, customers are at a problem. So they do a lot of predatory business practices, and that's why they are always under the purview of regulators. And many people saying that you have to break the companies to allow for competition to prosper. And you can do center analysis using this Porter 5 forces. So Porter 5 forces, the very big, the good advantage is that it can allow you to think in a good way. The only limitation is that it doesn't take technology into a picture, and lot of tech disruptions are happening. A lot of disruptions are happening on the technology side. So that is the only limitation of Porter forces. And second is that the new entrants or whatever forces that you can take, it's always a subjective analysis. So you should always supplement Porter 5 forces with a SWOT analysis or a pestle analysis to further narrow down your recommendation. So it's a book value based approach. Okay, fine. Now one more thing that happens is that why startups require a lot of money is purely because they don't want to get competition. Let us assume that I am operating out of a new market, and I have a value proposition, I have a customer, but there is always a risk that someone like a Reliance can come, and because what happens is that there is something called as first mover and fast follower. First mover is someone who gets into the market first, right? And fast follower is someone who doesn't take the risk of the first mover. So meaning that he has looked at the first mover and understand that it is far more profitable, and what he does is that he uses his capital and intimidate the first mover and remove him from the market. That's where capital becomes very important here. So if you don't have good capital, if you don't have startup funding, it is very much possible that either you get acquired, or you would the same value proposition can be imitated by a bigger player with a higher capital and sort of net worth. So that's why we say when it becomes a winner take it all scenario, it is always needed that you have a lot of capital in like someone has to back you with a lot of money, like a SoftBank or Sequoia or somebody else. So it's just an example of Facebook. How was it pre-IPO stage and post-IPO stage? And if you look at it, how its total assets has increased over a period of time. And it actually says that Facebook pre-IPO was in a different market, but as that markets became crowded, it started venturing into new markets, which is substantiated by your PP&E, total assets. So this is one of the conversation that was I don't know, it was tapped or I don't know, it was recorded when Zuckerberg had it with the CFO when he told the reason why he wanted to acquire Instagram and Facebook. What he said is that he's acquiring the company not because of the capability alone, but because that he wants to save time, because the value of any social media platform is dependent on the number of users using that platform. So more the users, more the value. And if you have a competitor who is trying to switch your user base, like an Instagram or a WhatsApp, so what happens is that over a period of time, Facebook has to replicate your WhatsApp or a Instagram. Like that, and it doesn't want to do that. So it wants to acquire, it doesn't want to lose time. They integrate it with Facebook so that as a Facebook user I have options. I can do Insta, I can do WhatsApp and all those things. Something called the defensive acquisition. This was primarily came as an evidence during the antitrust issue that Facebook had in 2012. So this is the last part of our discussion that we are coming in, which is the fundraising. So we have talked about valuation, value creation, etc. Now let us talk about the funding. So as we discussed earlier, you can get funding through selling equity, through borrowing money, and final part of it is that what will be the agreement that has to happen before the money is transferred, which is term sheet and etc. So as I told you, as the value creation starts happening, as the company starts profitable, it will start doing buyback. So the equity dilution, it will move into equity concentration as and when the company starts maturing. So if you look at your basic sort of structure, you have an asset. That asset is funded by an equity and debt, and you want to buy a new asset. And who is funding that asset? Let us assume you are selling an equity. So you bring a new shareholder in. So your equity holder increases. So what happens is that instead of you as a founder, you bring a new investor. And that new investor who has funded you money to grow your book value also has a share in your company. And primarily he is not going to have a common share. He is going to have a preferred share because he is worried about his downside. He is saying that if the company closes or if the price that I pay to buy a share, what happens if value reduces, then at least I need to ensure that whatever I pay, it comes back. So which is a preferred stock, gives you that protection. So as you say that it's always better that you start a dilution at a lower stage, meaning that you don't, as someone asked, you have 100 shares, don't give 50 shares immediately to an investor, because already if you have diluted 50% at the seed round itself, then by the time if you survive and become an IPO, hardly you will have 2% or 3%. So there is no motivation to run. So be careful, and also you have to be very clear that diluting equity at a later stage becomes important when valuation increases. So let us assume a value per share is 1 rupee, but over the stage it becomes 1000 rupees. Then someone who has to pay 1000 to get a share, dilution actually reduces. So as you improve the value of your company, so every funding should result in an improvement of your book value. So we'll take 2 examples into account. AC is not working. We'll take 2 examples into account. You do a dilution, but what happens if your book value doesn't increase? Yeah. So what happens if a book value doesn't increase? So let us assume there are 100 shares at a 10 rupees. The valuation improves. So at the next stage, the book value improves from 10 to 40. So in that case, if you even issue 15 additional shares, you are raising 600 in capital. So as your valuation improves, that is the pre-money value increases in every funding round, your value of the company increases. So even though your dilution is there, but as a percentage of the valuation, you will be at a far better stage. So this is the chart that I plotted it out from startup to IPO, and what happens to the founder. So it starts with 100%, it ends at 32.3%. That's the dilution that happens to him from startup to IPO. But also you need to understand that what's the value of the company, and the same thing happens when dilution is there. But what happens is that the book value remains the same. So that means you are adding capital, but that does not essentially improve your valuation. That means you are not doing anything which is improving the value of the company. So in that case, if I had 15 shares and the book value is 10 rupees only, then I am just raising 150 against the 600 that I raised. So you dilute more equity because people are able to buy shares at a lesser price than what it was before. So I will also take you into what happens in a VC financing stage. I'll just take you to the sheet and then an Excel sheet. So as we know that a startup doesn't finish at one round, he will do multiple rounds. So and every round there will be a valuation carried out. Every round will have a term sheet, and every round they will have to look at what is the TAM, what is the customer growth, what's the cost structure and all. So there are various rounds from seed round to series B, series C, and cap table will change at the end of each round, and there will be a pre-money and a post-money valuation, and based upon that the term sheets and down rounds will be arrived at. As a thumb rule, never dilute your equity more than 20%. So at the start itself, and when you do a ESOP, when you do a stock option, then that stock option has to be diluted from your shares, not the investor shares. So you have to create a ESOP pool from your shares. So let us look at this example. And in the round 1, I have 1.5 million shares, and I am going to an investor. I am asking him that you give me 1.5 million shares and an exchange of 1.3 million. So the pre-money will be 1.3. This pre-money is actually done by DCF. So you have to do a discounted cash flow. So in this case, I have assumed it is 1.3, but subsequent round we will do the valuation also. So pre-money divided by your number of shares will be the pre-money price per share. This will be 1.3 by 1.5, and so you are giving him 50% of the company at the round 1. Now what happens? You go to the round 2. So you do a DCF, and so you go to a investor and you say that okay, at the end of year 5, I will have this much sales, and at the end of it, the multiple will be around 2x. I have an exit valuation of sales into EBITDA. Then I look at a hurdle rate. So what I do is that year 1, I take an investment which is 6 million. So the 6 million is coming from 2 investors. Investor 1, who has already invested earlier, is giving me 2 million, and the new investor is coming, who is giving me 4 million. right? So this 154.6 you arrive at, you discount it at 50%, at the year 1 it is going to give you a pre-money valuation, which is 24.5. Post money is nothing but pre-money value plus investment. So whatever investment you have added is 6 million, which will be your 30.5 million. So how many shares you are going to give? So we have to model the cap table. So your pre-money share will be your 24.5 divided by 3 million, which is the number of shares. So it will be 8.18 will be the pre-money. So 8.18, if how many shares that investor 1 and investor 2 has to buy. So if he is investing 4 million, 8.18 is per share price, then he invests 0.489 million. Investor 1, he already has 1.5 million shares, which he has bought at 0.87. He is investing additional 2 million at 8.18 price. So the total number of shares is 1.745 million. So the total number of shares has increased from 3 million to 3.734 million. The shares outstanding for management has not changed, so which is still at 1.5 million. So in that case, what will be the ownership? The cap table will change. So at the end of the round 2, the dilution still happens for management, which is from 50 it becomes 40.2. Yeah, and what is the cap table at the for each investor? This is for what happens if the round 2 happens. The same you can extrapolate for round 3. So you are again discounting the hurdle rate, and you say that what is in the what is the discounted rate when you take the year, you take the money at year 4. So year 2, so you get the present value, which becomes the pre-money, and then from the pre-money you had post money, and then you model the cap table accordingly. Now in each of the cases, what you would have seen is that the pre-money value is increasing. For 1.3 it has moved to 24.5, and 24.5 it has moved to 50.3. That means the company is doing very well, and the value of the company is increasing. So in that case, the investor does not have a problem in diluting the share, purely because the subsequent investor is going to buy the share at a higher price. But what happens if the pre-money value reduces in the next round, which is called as a down round? Down round meaning that let us assume from 1.3, 24.5, from 24.5 it moves to 8 million, not 50.3 million. So in that case, a new investor comes in, he buys a share at 8 rupees per share, which is causing a lot more dilution to the earlier investor. So which is called as the down round. And there are protective provisions to ensure that dilution does not happen. It's something called as anti-dilution. You have ratchets and all those things, which is a different conversation all around. But I'll just tell you how the dilution happens in the case of a down round. So you look at the ownership: 35.9, 43.5, 13.5, and 7.1. Right now, what happens if the pre-money reduces? You look at the founder ownership, drastically reduces to 24.1, right? And the investor 3 who has invested 4 million, he gets 26.7. So the late stage investor, when the dilution happens, is able to get a far more ownership than the initial stage investor, which is what the initial investors, early stage investors will argue against, because their money is going down the drain. So this is basically how a cap table gets modeled at the end of each round. And as I told, valuation has to happen at the end of each round, and you need to have a term sheet at the end of each round. With the venture capital returns. So the two things is that I put money, and what are the metrics that I would calculate when putting my money? The two important metrics are IRR. IRR meaning that I'm sure everybody knows it, and when your IRR is greater than hurdle rate, then you get a value creation. Something called cash on cash, meaning that how much I invest, how much I get, you divide both of them, you get a cash on cash multiple. And always the ownership is carried after the investment, which is post investment. And what are the benefits of a convertible preferred? Is that if there is an upside potential, you have the luxury of converting into common stock. But if there is no upside, then I can get dividends, and also I have a liquidation preference, meaning that whatever money I have invested, I will get back that at the end of the sale. So now in terms of what are the provisions that you keep that change. So you can have a dividend feature, you can have a participation feature. Dividend feature meaning that every year I have to get a dividend. Now the dividend need not be paid at the end of the year. It can also be something where at the sale you accumulate the dividends and pay it apart from the proceeds. The third is a participation feature, meaning that I am a preferred equity holder. I incorporate a liquidation preference and a dividend feature, meaning that I will get so let us assume 50 million is the valuation. I put 10 million, so I have to get 10 million back. So first 10 million is paid to me, so the valuation becomes 50 minus 10, 40 million. And then I also get dividends at 5% or 8%. Let us assume that is also paid to me, which is 2 million. So it is 40 minus 10 minus 2, which is around 28 million. In that 28 million is now available for common equity. Now what participating feature says is that the preferred holder can also have a participation in that common equity also. So there will be the participation preferred feature. So there is an example. If you are interested, you can have a look into it. It's basically that you calculate you take 1.3 from the investor, then the post money is pre-money plus investment, and then you do a DCF, and what happens is that hurdle rate is around you do an EBITDA multiple to arrive at the valuation, and at a 40% hurdle rate, and then investor 1 will have a 25% ownership. So at 40.6 exit, you will get 10.2 million. So you invested 1.3 million, you get 10.2 million at exit. So IRR is around 67%, and cash on cash is around 7.8x. So multiple rounds, as we have seen, it's similar to what we have seen in the earlier example. The one thing is dividend. So dividend is what happens is that if you pay let us assume that investor 1 takes 8% dividend. So in that case, what happens is that what is the total dividend that the company has to pay? So you have to look into that, which is what is the total investment that you do at the first round plus what's the total investment that you do at the second round. You calculate dividends accordingly. Then you take the ownership of the investor 1 and then calculate the dividend for him. So ownership equity ownership is 24.8%. So of which in that remaining equity after subtracting dividends is 39.4. So 39.4, 24.8% of 39.4 is 9.7. Then investor 1, how much dividends he has to get? So he has not put the entire money. So accrued dividends for investor 1, that has to be added up. So which becomes 10.4. So if you look at it into that, if you have dividends incorporated in your shareholding agreement, your IRR improves. So it was from 55%, it became 56%. Your cash on cash improves. Now what happens in the case of participation? Participation, as I have said, is a liquidation preference. So total investment that has been put is 5.9 billion. Like if you look at all the investment that has happened is 1.3 plus 4.6. The total investment has happened, and in that 5.9, how much has investor 1 participated? It is 1.3 plus 1.1. 1.3 plus 1.1 is 2.4. So you subtract that from the valuation, and then you add these two, you will get 11.3. So now he has invested 2 times, one at the first year 0 and second year 2. If you look at it, IRR improves because he has incorporated participating preferred, and your cash on cash improves. So what I am trying to say is that as you incorporate more downside protection, the agreement becomes far more investor friendly than the founder friendly. So your returns improve. Now it's a function of negotiation, right? Especially when you have a funding winter or when the capital raising becomes very scarce, then VCs can have a higher leverage. They would be able to incorporate all sort of protections into them. I wanted to just give you a flavor in terms of how you calculate returns and how the cap table changes at the end of each round. Now, as I said, it is not only equity that you can issue; you can also issue debt. And when I say debt, it is not conventional debt. So, when you look at debt, right, you have debt at various stages. A house loan, you get at a very low rate, purely because the collateral is your house. So a bank can always sell your house and get money if you don't pay. So the risk is far less for the bank compared to a personal loan where you don't have a collateral. So your rate is higher. So same comes mezzanine financing and etc. So when your debt becomes more riskier, your debt takes a characteristic of equity. So in that case, what essentially happens is that as a debt holder, you ideally would want the company to perform well, because if the company does not perform well, you will not be able to get your returns back. So type of debt investments, and every stage the interest rates will increase, and you also have something called as covenants. Covenants being that there is an agreement between the lender and the borrower saying that what all he has to do to ensure that he is able to get continued financing. So there are something called positive covenants, negative covenants, meaning that he has to share returns at the end of every year, and he should not if he's not able to, if operating performance has become less, then he should not give dividends to the equity holder, because for a borrower his risk increases. So there is something called as a convertible debt. And see, the point is, many people think convertible debt is very simple, preferred equity is complicated, but there are cases where convertible debt becomes a big problem if you don't understand that feature. What happens in a convertible debt is that it's essentially a debt, so no dilution happens, and then there is a conversion option given to the debt holder to convert the debt into equity, right? So at that time when it happens, there are a lot of times what has happened is that the investor has taken the entire money from the founder, leaving only split equity to him. So look at this example. Investor injects 1 million and acquires 60% of the company. The founder has, two founders have 40%. But in the articles of association, what they have written is that any ownership, any decision related to the business has to have 75% approval of the shareholder, meaning that the investor himself does not have a veto power. So there has to be a decision has to be taken in consonance with the founder. Now the same case, what happens if it takes a convertible debt? The convertible debt, what happens? You inject 1 million, and then what you say at the end, I also inject another 1 million of convertible debt. So when that happens, your investment becomes not 1 million but 2 million. So 2 billion, and the total is 0.33, 2.67. So 2 by 2.67 is around 75%. So automatically the ownership increases from 60% to 75%. He attains a veto power and he totally controls the business, and the founders are left with nothing. So he can even replace the founder. So the issue is that be careful when you do the funding, because there are a lot of cases where you might get removed from your own business. You take the risk of that. Shareholder agreement term sheet, we have reached the last stage of our presentation. So see, there is something called as the articles of association whenever you incorporate a company, and which essentially says that what is the company, where is it located, who are all the shareholders of the company, and they also says who are the minority and majority shareholders. But the problem here is that the majority shareholders can dominate the minority shareholders in anything. If they want to sell the company, there's something called drag along right, meaning that you can force the minority to sell the share along with him, so etc. So many minority investors don't stop with the article of constitution. They also want a shareholder agreement. So shareholder agreement is something which is not standardized. It is something which is customized between the two parties, and which essentially gives certain amount of power to the minority shareholder in terms of able to save its investment. So this is a sample term sheet or shareholder agreement that I have. I'm just plotting out important examples. So what it says is that number of directors has to be 6, with top 2 directors being nominated by preferred shareholder, meaning that the investor has a say on the composition of the board. And also he says that no decision can be taken without his consent. And the third is that no material change in the nature of the business can happen without his consent. Like if founder wants to sell a company, then that cannot happen without the consent of the preferred stockholder. So as I said earlier, don't do fundraising only for cash. Also look at the investor, like how knowledgeable they are, because you are going to live with them, right? After the deal gets closed, he will occupy a seat in the board, and he will influence your business growth, etc. So select the right investor and approach him in a nice way. And now the term sheet also has certain features. First is non-binding, so it's not a shareholder agreement, but it basically pinpoints the major rules that both of them have to agree upon, and some of them would include no exclusivity, meaning that if I'm going to give you money, then you should not approach another investor for more money. Then there is something called as a voting right, liquidation preference we have already talked about, and anti-dilution, meaning that if the pre-money reduces in the next round, where my dilution increases, then how am I going to protect it? And there are multiple ways. There is something called the ratcheting, meaning that I can have 100% protection, but when that happens, the founder is in a big problem. So generally what is said is that don't agree to those provisions during the negotiation part. And term sheets is not only for VCs, right? It can also even used for debt. So you can have something called as a loan term sheet also. So list of rights in case of convertible preferred shares, and these are very important in addition to the valuation. So how much rights are going to give him on the voting side, on the board side, liquidation preference, redemption rights, that he can also say that after 3 or 4 years, you have to buy back my shares. So at this price, so I invest in 10 rupees, you have to buy back at 20 rupees. He decides the price, he also decides the time when the redemption has to happen. Conversion rights, anti-dilution, protection, preemptive, meaning that if the founder is willing to raise additional round, then he has to first talk to the existing investor before. If the existing investor is not interested, then he can go to the new investor. This is a preemptive right of first refusal. Drag along, we have already talked about, where he drags the minority investor along with him. That's all. I think we have closed the session. So I think we have discussed all these things in detail. So understand through 3 things. Understand the corporate life cycle whenever you invest in a company. So early stage investing is different, late stage investing is different, IPO investing is different, investing in a mature company is different. That's why private equity are different, venture capitals are different. And then understand different types of valuation that you can do for a company, and also look at term sheet and shareholder agreement.
The NDTV episode?
NDTV Adani one?
Adani. It was convertible debt situation, right? They borrowed some money, it was convertible debt, and they...
Yeah, so what I understand from NDTV was they had taken money from another entity and which Reliance was controlling, and then Reliance sold it to Adani. Indirectly, Adani became the shareholder, and then they demanded the debt from founders Pranav Roy. Was not able to give it back, so he acquired the company. So it was not like the Adani was having it. So it became like Adani acquired that company that gave them the convertible debt.
Yeah.
So I have a question regarding the term sheets. So just 2-3 guidelines that I would like to ask. One is, what are the typical lock-in periods that
that is negotiable. So
negotiable. What are the typical guidelines?
And lock-in periods varies from each round. Even an IPO,
seed
there is a
round,
lock-in period.
In the seed round, what are the typical lock-in periods?
Lock-in period generally in seed round applies for founders because they don't want founders to run away.
Right.
So in that case, they will ensure that the founders don't sell the shares.
Right.
And if at all founders sell the shares, like let's assume 2 founders, one enmity happens, one guy leaves out. So in that case, either the founder one has to buy his share, or the existing investor will buy the founder shares. So the lock-in periods at the earlier stage is more founder specific. The later stages it becomes investor specific.
Got it. And you mentioned one point where, let's say, the investors have entered at a price 100, but due to some reasons the next valuation round goes below that valuation, and then the dilution will happen from the investor pool, right? So you said that it's better to not have that condition on the term sheet for founders.
No, founders anyway, see, if the fund is raised from an investor, the founders are anyway going to dilute. And what happens is that now your dilution, meaning that more shares will be issued at a lower cost, which will ensure that the investor one is at risk. But what happens if the company exits, closes down? See, what happens is that you burn a lot of cash, right? Now you need more cash to survive. So in that case, the investor one has to accommodate that, because it's better he gets some money rather than liquidating and not getting any money. So those dilution rounds becomes a big pricking point in case of a down round. So in a very good situation, right, founders don't think these situations will happen. And so they get into all these points in the term sheet. But when the business is not doing well, when the macros are suffering, or where you are not able to get a premium on your valuation, that's where these rounds, that's why you need to build a lot of scenarios when you do a valuation. It's not enough that you only think about optimistic situation. You also think about negative situation. See what will happen as a founder to you. You will get replaced immediately, or you will get sold. So investor one will get a veto power, he can do anything. So you need to take that into account, and also you need to ensure that even if there is an anti-dilution agreement, let it be not very stringent. It's not like the entire protection is coming to me. It's not like, okay, at 10 million I invested, that's become 5 million, so my share count has to double. If that happens, then the founder will lose away, because the dilution is not only happening for the investor, it's also happening to the founder. So at the end of the founder is already having a 20-25% cap table. If he gives the entire twice the shares to the investor one, just imagine it will be even 10% or 12%. In that case, there are 2 things can happen. Founder will not have any motivation. He will, and all the second thing is that founder will say, why should I work? Not only the founders, even the employees, right? Because they are given options, and they are not able to exercise that option. What's the use of that option? So many people join startups because they get ESOPs, and ESOPs is a function of the valuation, and the valuation reduces, then the entire it becomes a paper share. Many people will leave. That's why in the interest of the company, founders say they don't accept anti-dilution. Just a feature. Even if it's an anti-dilution, it is not like you will get 100% protection. So that's what ratcheting. Ratcheting essentially means that what will happen in case of a down round. Then you have multiple ways to arrive at a ratchet.
Thank you.
Participation feature is nothing but after you pay the dividend, after you pay whatever is there as available to all. So in a cap table, your lender will have the highest seniority. Then comes your preferred equity, then your common equity. So when you take the preferred equities rights into account, which is your dividend feature and your liquidation preference, then now the money is available to all the common equity holders.
Correct.
What the preferred equity will say, when that happens, his preferred equity will get converted to common, and then he will participate in those proceeds.
The waterfall method, right? So I understood the waterfall aspect of it.
So if you look at this example, 40.6 is the valuation, right?
Got it.
And total money that is invested is 5.9.
Yeah.
Right? And then that is so entire 5.9 is given back because it's a liquidation preference.
Okay.
And then 1.2 is the total dividend,
which had to be given back.
So you have to deduct. So you get 33.5.
Okay.
So valuation is not 40.6. It is 33.5 available for the common equity holders.
Okay.
In 33.5, what is the ownership of investor 1? 24.8%. So he gets a 8.3 out of this. But he doesn't stop at this. He gets addition a dividend and a liquidation preference. So he has invested 2.4, he gets 2.4 back. He gets a dividend of 0.7. So you add 8.3 with that, it is 11.3. If you don't participate, that is 8.3 will not get. So you will be only left with 2.4 or 0.7. Or if you don't do a participation, then you have 8.3 plus 0.7. That's why I compared all the three and I say that your participating preferred with dividend will always give you a better IRR.
But 24.8% was on fully diluted basis. No? So
yeah.
In that case, how could we differentiate on liquidation of 5 or 5.9?
Whatever he has invested. So 4.6 he has invested in round 2.
Correct.
1.3 has invested in round 3. So total investment that has to come is 5.9.
5.9.
So the 5.9 has to be given back because all these are preferred stockholders.
Correct.
Right. So now the total valuation minus liquidation preference is available for common equity. In that common equity, we are looking at how much investor ownership. Investor 1 is owning. He is owning 24.8%.
Correct.
So 24.8% of the common equity he gets, but he doesn't stop with that. He also gets a dividend for his investment. So he has invested 1.3 and 1.1. For that he will get a dividend. And then he has invested 1.3 and 1.1 as a liquidation purpose, so 2.4. So you get 2.4 plus the participating and the dividend.
He's getting the advantage of both the debt and the equity side of it. Yeah. Perfect. Thank you.
Hello. So I had a question related to data sources which you follow, and also some of the books which you can refer to our audience.
Yeah.
Here.
See, I am not able to see. Books are related to what?
Books related to your private equity and venture capitalists.
You can look at the valuation guidelines,
Okay.
private equity valuation. They give you a beautiful set of rules. But again, it is very, what I meant to say, it's difficult to read because there will be a lot of accounting and legal language get into it. But if you're able to read it and understand it, it's one hell of a book. They just give you the rules. At what point, it's just a rule book. What point TCF has to be used, what point this has to be used, and how do you adjust for differences and all. So that you can have this is around 40, not more than 40-45 pages. You can read it, but it is very hard to read. But you have this Peter Thiel and all these guys, right? But those are like more like stories. You can only, but you like reading those, but not lot of numbers that they will focus on. They're basically on the soft skill set. See, again, I'll say venture capital is also more about soft skill, right? You need to have a great networking. You need to understand the investor very well, and the personal relationship matters a lot. So some of the greatest, even Bill Gates or some of the biggest guys, they have always had a great relationship with the venture capital companies. It's not like a mature company DCF or like a borrower banking relationship where it is very transaction oriented. It is very strategic oriented. So these are only the guardrails you need to be very clear about. And also have a lot of legal language. Appoint a good lawyer because if any of your if scenarios doesn't work out, then your company can be entirely snatched out from you. So these are more about what are the guardrails that you need to perform. But in addition to that, whole lot of soft skills. How are you going to sell your company? How are you going to sell your idea? So the storytelling approach. How do you build a pitch deck, which is very much specific to the person who is giving you money. So those are the things also you need to focus on. The objective of this discussion was purely on the valuation part. So I had to divulge more on that. But a lot of soft skills, lot of building a story, and why you need a VC, why you do not need a VC. This is also a big part of the solving the puzzle.
Anybody else has any questions?
I just wanted to know, these startups have the corporate governance side in the startups. So that is not very, you cannot check.
Corporate governance is what happens, that lot of VCs deliberately overlook corporate governance because they are there for short term. That's why I said it operates like a Ponzi scheme. I build you 10 rupees, then I chase you, you have to give me revenues. So the more pressure is there, you start dressing up, you start recognizing revenues when there are not revenues, you start cheating your customers, you say that you will do this but you don't do that, like what by you, lot of these things. See, many people opt to do that because of the pressure from VCs. Why the pressure from VCs? Because they are over promising but not delivering. So they have taken that money at a very high valuation, and when that is not translating into the reality, then VC starts asking questions. So
on the line, do you see the corporate governance issues being?
See, that's what I said. Now, it's corporate. The loopholes is not only from the founders. The VCs are colluding in it. So the collusion is happening equally. And what happens is, I as a VC, we go to the second round. I sell my holding. I get a higher price. I move out. It's as good as speculative, right?
Yeah.
So you cannot do this fraud without the collusion of VCs. So the entire reformation has to happen on the ecosystem per se.
Yeah, thank you.
And you don't have a SEBI or a regulator overseeing that as you have it for a public market. So public market, you always have a regulatory body who is very, very strong in able to supervise how the companies are performing. And there are a lot of things that they have to adhere to, which the private companies don't have. So that's the problem. That's the reason. So if you have good investors, that's the reason I am reiterating it again. You need to bring good VCs onto the board who are ethical, who are transparent, who has a track record. So those VCs will be able to promote good corporate governance. Otherwise, if you are there for VCs, they are also, VCs are also under pressure because they are collecting money from LPs, right? And they have to generate return. If they don't generate return, they are not going to open a new fund. So even VCs, every VC has to open a new fund for which the LP has to fund. The LP will only fund when you have a track record. So it's a cycle. So they are under pressure to deliver returns. Founders are also under pressure to deliver returns. It becomes a collusion.
Thank you. Thank you very much for the session and demystifying the entire startup ecosystem for us. A small token of appreciation from the CFA Society. Thank you very much.